the idea that this tariff as a negotiating tool is too consensus.
We can talk about tariffs as much as we want, but we don't know what's going to happen.
The president seems to be far more serious about tariffs than was consensus in November when he won.
I really don't know. I don't think anybody knows but the president.
Policy backdrop is changing rapidly, and people are not sure exactly what to expect.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Is it Friday already? Hitting the ground running to start this trading week. Your scores look like this. Equity futures on the S&P 500 down by 0.1%. We are struggling to bounce following the biggest one-day loss of the year so far. Just one line from the president, shaking up global trade.
On the tariffs, is there any room left for Canada and Mexico to make a deal before midnight? And should we expect those Chinese tariffs, the extra 10%, to take effect tomorrow?
No room left for Mexico or for Canada. No, the tariffs, they're all set. They go into effect tomorrow. China also had an additional 10, so it's 10 plus 10.
As of this morning, 25% levies on imports from Mexico, from Canada, raising tariffs on imports from China to 20%. And this market reacting big time yesterday afternoon.
This market is falling out of love with the policy mix and the sequencing of Donald Trump. And I think that you can say that as you see the Magnificent Seven down more than 10% in the past 2 weeks, as you see the small caps really getting hit hard. A question here now is, are these on for a longer period of time, or how quickly do they come off? And that is the new hope for markets that maybe fully haven't grappled with the idea of not only tariffs, but retaliatory measures from Mexico, from Canada and China.
To build on that, I think you're absolutely right. The people who believed this day wouldn't come now believe this day won't last very long. And these tariffs will be off in a week, 2 weeks, 3 weeks, maybe sooner.
We don't know. And another big question, of course, is if you have auto companies, which there's a lot of reporting in the Wall Street Journal that they were in having conversations and a dialogue with the administration. Will there be carve-outs in a few weeks or a few months? If you look at Trump 1.0, there were carve-outs. Remember before the election, though, Howard Lutnick, who ended up becoming the Commerce Secretary, said on this set and said there won't be any carve-outs. So now you have this whole game of chicken. When will these levies be lifted? And if not, what can we see? We know Canada's coming out with tariffs immediately. China's already done it. We're waiting on Mexico.
It's already in the data. You've seen it in consumer confidence. You're seeing it at the ISM yesterday on manufacturing. The headline number was okay, but beneath the surface, prices paid moving in the wrong direction. New orders, employment contracting. That's a bad mix for the economic data.
It is something that rhymes with ragflationary, or, this idea of stagflationary light. You have this idea that you've got a weaker than expected headline number, almost in contractionary territory, but the employment component very low, the new orders component. And you mentioned this, prices paid at the highest levels going back to June 2022, which was the peak of the inflationary boom that we saw after COVID.
If you are just joining us, welcome to the program. We're softer here on the S&P 500. We're negative by 0.1%, adding to the losses in yesterday's session. We begin with our top story, a green light for tariffs. President Donald Trump following through on threats to hit Canada, Mexico and China. Our team coverage starts right now with Bloomberg's Tyler Kendall in Washington, Divya Balji in Toronto, Carolina Milan in Mexico City. Tyler, first of all to you. A lot of people thought maybe this day wouldn't come. Here we are.
Well, John, you heard President Trump there saying yesterday that there was no room left for negotiations. And we have to keep in mind that this specific batch of tariffs was really tied to some tangible policy priorities for this White House when it comes to immigration and fentanyl. We know President Trump was tracking closely overdose deaths as a metric leading up to today. I actually pulled the most recent data from the CDC, which shows that overdose deaths plunged last year by 24%, but it is still the leading cause of death among Americans ages 18 to 44. But as you've been discussing, this really kicks off a countdown clock that goes beyond this White House's border policies. Just look at President Trump's rhetoric around retaliation, for example. He's largely brushed off concerns, saying that that will ultimately just get factored in to those country-by-country tariff plans that we're expecting when his reciprocal plan is released on April 1st.
Caroline, I want to bring you into the conversation because we yet to know what Mexico's response is going to be. What are we waiting for?
That's right. There's a lot of expectation around President Claudia Sheinbaum's morning press conference that's held every day at 8:30 a.m. Eastern Time, and today is not an exception. Yesterday afternoon, when President Donald Trump announced that the tariffs were going forward, her team told us that there would be no statements until she speaks herself. So what are we waiting for in this press conference? Certainly to see if there's going to be retaliatory tariffs. Leading up to this day, President Sheinbaum has been talking about using a cool head, about waiting for the measures to be official, and she's also spoken about how the government has a plan A, a plan B, and a plan C. She hasn't yet disclosed what those are, so there's a lot of expectation around whether there will actually be retaliatory tariffs or some other kinds of measures. If there will be more measures alongside the border or related to security. And all of this comes at a point where Mexico's economy is poised to contract this year. So it's a very urgent moment for the country.
Meanwhile, Divya, we have gotten a plan A and a plan B from Canada. What are the details?
Yeah, so as of right now, about 25% of tariffs have been slapped on about 30 billion Canadian dollars, 30 billion worth of goods. Now that's going to take in effect right now. It has been for the last few hours. And then from here, in about 3 weeks, Canada will slap another 25% tariffs on about $125 billion worth of goods. Now this second amount, is really what's key here. It's hitting a lot of the big ticket industries, cars, trucks, steel, aluminum. That's really where you're going to see the big hit. I think, could this be seen as a bit of a measured response? Canada has been talking about doing it this way since the initial threat of tariffs. So is it possible that they're hoping to go back to the negotiation table and have a little bit more of a discussion before they actually have to put these new set of tariffs on in 3 weeks? There's also the possibility of, the whole fact that Trudeau is stepping down in a few days, the leadership race, does that call for something else? Is that why we have a few weeks for the larger amount of goods to get tariffed later? I think there's a lot of these questions that still have not been answered.
We're not done yet, that's for sure. Divya, Carolina, Tyler, thank you. On the agenda still, on the calendar, we've got 25% tariffs on steel and aluminum, potentially a week away. Early April, 25% on autos, chips and pharma. This is just getting started. Julian Emanuel of Evercore ISI joins us around the table. Julian, good morning to you.
Good morning.
I'm going to use your words to set up the first question. The sentiment shift during February to the type of pessimism more consistent with major bottoms after protracted sell-offs rather than so near all-time highs is nothing short of extraordinary. We're 5% away from all-time highs, and yet pessimism is falling off a cliff right now. There is literally no confidence at the moment from business leaders, from consumers, from the people we speak to day after day. What gives? Either sentiment needs to catch up or the market needs to catch down.
Well, two things just to highlight how extraordinary it really is. We looked at bearish sentiment and at these levels, the average drawdown from the high is 29% when you get these levels. The lowest drawdown was 13%, and as you mentioned, less than 5%. It's really what it is again, as you pointed out earlier, there was not an expectation that we were going to get what we've gotten this morning, that the tariffs are actually on and in place. And to be fair, our house view is that they will not last that long because the damage to the economy is too great. But this is classic financial market risk reward. And when you talk to investors, they don't see the potential reward outweighing the risks of being aggressive here.
We started the show saying that people who thought that these tariffs were just a negotiating tool are now saying it's not going to last very long, and they're still just a negotiating tool. At what point does it become irreversible in terms of the effect on markets? The idea that even if they stay on for a prolonged period of time, that requires some sort of response in supply chains, in growth expectations, in, frankly, trade relationships globally?
Well, you're certainly starting to see it. And I think the uncertainty is also a function of the geopolitical chess pieces being reconfigured as well. And again, that ISM data, incredible. Prices paid elevated, in terms of precautionary buying of goods. And then, of course, new orders falling off the cliff because you already bought the goods. There's a psychology aspect to this, which is what is very important. And I think it's also interesting because if you look back to the original trade war in 2018, when the stock market backed off President Trump's rhetoric backed off, okay? The danger here is particularly when you look at 5,700 in our view is important because that's where the market was on Election Day 2024. And he's never had what we'd call an adverse mark to market in either Trump 45 or obviously Trump 47. Does the rhetoric change? And the market is not so certain of that.
You mean the test of the Trump put, whether that actually still is in effect? If it isn't in effect, what's the downside? I mean, are you becoming actually bearish, or are you just saying that there's more heightened uncertainty on both sides?
So we have viewed 2025 as a continuation of the rally, but with the different character of what we call 3 steps forward, 2 steps back, heightened volatility. So whatever the baseline of volatility was in the VIX last year, 14, 15, that number is now more consistent with the long run average of 19. Could you get to a downside where growth sub 2% and inflation sticky towards 3% without a recession causes a test of a number like 5,200? It's certainly not outside of the realm of possibility. We'd treat that as a buying opportunity. But when you have this kind of uncertainty, you have to expand how you're thinking about the tails.
Julian, we're only 6 weeks into this administration, though. If he was to back off now, then he's the boy who cried wolf for every other date on that calendar.
Yeah, and that's part of the fact that, you know, again, what did he learn from the first administration is that history tells you, regardless of circumstances, you're likely to lose the majority in the House in 2018, and we know the way politics works. They'll start running for the 2026 campaign this fall. You've got to front load everything, so the accumulated uncertainty is in these first few weeks, and it's sort of, you know, let the chips fall where they're going to fall.
Would you buy stocks here?
We want to see a little bit more despair, quite honestly, consistent with that bearish reading. Yes, the market has acted as if it is approaching despair, but to us, when you think about all the catalysts, you think about that speech tonight where clearly he's going to talk tough, no question about it. You think about the potential for the government shutdown on March 14th, which matters now because of the reception of Doge. The risk is not quite balanced versus the reward at this point.
Fed on March 19th. How does all this change their meeting in a couple of weeks' time? 2 weeks tomorrow.
I don't know that the rhetoric is going to deviate that much. You know, you might see downgrades to their economic forecast a little bit. If you're thinking about market confidence, you might want to see a slight downgrade to the inflation forecast, but you're not likely to see it because we really don't know what the effect of the tariffs are. The bond market's telling you that the inflation problem is not the problem, it's growth. But the statistics don't confirm that yet.
Final question, year-end price target, 6,800, correct?
It is.
For a lot of people, looking back to the election in early November, they made the argument that the overall policy mix was positive for stocks, pro-risk, pro-growth. The trade was going to be a tricky part of it, but it was one piece of a much bigger policy platform. Is that still the correct way to look at this country?
It is. But again, there has to be an understanding of how the pieces fit and a sensitivity around the fact that words clearly, even before the actions have been implemented, have consequences. And, you know, from our point of view, our guiding light is that earnings growth still looks 9% to us. We have not moved. We don't anticipate that's going to come off.
Julian, appreciate your time. As always, sir.
Thank you.
What a start to the week. Julian Emanuel there of Evercore ISI. We're late on the economic data today, but look out for tomorrow. ISM services. Will it confirm the slowdown in ISM manufacturing? And then it's on to the jobs data, payrolls on Friday. Equity futures right now on the S&P totally unchanged with an update on stories elsewhere. Let's get to your Bloomberg brief with Yahara Hecker. So, Yahara.
Hi, John. President Donald Trump has imposed 25% tariffs on most Canadian and Mexican imports and has raised the charge on China to 20%. That affects roughly $1.5 trillion in annual imports. In response, Canada is set to impose phased levies on $107 billion worth of U.S. goods, and China is set to impose tariffs of up to 15% on American agricultural shipments. Meanwhile, the European Union will propose extending 150 billion euros in loans to boost defense spending. This coming as President Donald Trump pulls back on American security on the continent. The EU also plans to activate a mechanism that would allow countries to use their national budgets to spend an additional 650 billion euros on defense over 4 years without triggering budgetary penalties. And the FDIC is rolling back a Biden-era policy that required U.S. bank mergers to face steeper regulatory approval. The 2024 bank merger guidance was part of the Biden administration's effort to clamp down on consolidation among financial firms. The FDIC is also pulling back on a plan to enact tougher regulations of lenders' broker deposits. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara a little bit later on this morning. Up next on the program, the president follows through.
25% on Canada and 25% on Mexico, and that'll start. So they're going to have a tariffs. They can't come in and steal our money and steal our jobs and take our factories and take our businesses and expect not to be punished. And they're being punished by tariffs.
Up next on the program, Ed Mills of Raymond James as the President of the United States shakes up global trade and shakes up global markets. Equity futures negative 0.1% from New York City this morning. Good morning. So yesterday's session wasn't just about trade, it was also about the economic data. David Kostin of Goldman Sachs writing this: an improvement in the US economic growth outlook will be required to fully reverse the recent equity market weakness. Not turning bullish on this decline just yet. Equity futures down by 0.1% on the S&P. In the bond market, yields just about unchanged. The 10-year 4.1644. Under surveillance this morning, the president follows through.
25% on Canada and 25% on Mexico, and that'll start. So they're going to have a tariff. So what they have to do is build their car plants, frankly, and other things in the United States, in which case they have no tariffs. I would just say this to people in Canada or Mexico: if they're going to build car plants, the people that are doing them are much better off building here, because we have the market. We're the market where they sell the most. It's going to be very costly for people to take advantage of this country. They can't come in and steal our money and steal our jobs and take our factories and take our businesses and expect not to be punished. And they're being punished by tariffs.
So here's the latest this morning. President Trump delivering on his promise to hit Canada and Mexico with a 25% tariff and doubling the 10% levy on China. Canada and China responding with tariffs of their own, while Mexico's president is set to speak later on today. Ed Mills of Raymond James joins us now for more. Ed, welcome to the program, sir. We said just moments ago that the people who didn't believe this day would come now believe this day won't last very long. Ed, what's your message for them?
My message is I feel like I've been the Paul Revere of tariffs all this year. Kind of the tariffs are coming, and no one has really believed me. I think that there is an element of this that is absolutely about negotiation, absolutely about using the economic strength of the United States to push our allies in many cases to make changes. And I think that's the base case. But I also have told folks here at Raymond James, expect a lot of these tariffs. If it's not at 25% permanently, does it come in at 5 or 10% permanently? Because bucket one is changing policy. Bucket two is having enough revenue to potentially pay for policies like the extension of the tax cuts in a couple of months here.
Ed, what kind of timeline are you giving for some of these exemptions or potentially the lowering of the tariff rate?
It's really hard to give a timeline because most, if not all, of this tariff authority is solely within Donald Trump's discretion. He can decide at 12 o'clock today to take it all off. He can decide at 12:01 to put it all in. When I've talked to clients at Raymond James, they're expecting there to be exemptions on medical equipment, things for humanitarian aids, things that are going to be specifically important to consumers like energy. We do have a lower energy rate here from Canada. Donald Trump very much cares about inflation, but he also wants to be able to show, as we have the joint session of Congress, I'm not calling it the State of the Union tonight, where he is going to push hard, and we're going to have reciprocal tariffs come April 1st, April 2nd, more tariffs. This is a steady drumbeat that's going to happen, and Donald Trump turning it on, turning it off is going to be part of the negotiation.
What's driving these tariffs is really the fentanyl deaths. Donald Trump has talked about that. The president, as well as officials, have spoken to me about that as well. Kellyanne Shaw, negotiator in Trump 1.0, said on Bloomberg Television earlier this morning, this is the new normal. They seem to be swapping what maybe you'd use sanctions for tariffs, and this is the new realpolitik. In that sense, then, how do you decipher what's negotiation for national security and what's going to be a revenue raiser?
That's up to Donald Trump as well. I mean, I think, Annmarie, you're absolutely right. Donald Trump has been very concerned about fentanyl. And I think with a conversation about China, a conversation about Mexico, absolutely part of the conversation, absolutely a huge issue that needs to be dealt with. When I talk to my Canadian clients, they're not really understanding why fentanyl is as big of an issue. There has been shipments across the Canadian border, but it doesn't actually happen all that often, especially compared to others. Donald Trump is going to use whatever excuse he has to push forward these tariffs, trying to get those changes. And it's not quite clear exactly what he asked for. When I talk to a lot of my contacts, foreign leaders are concerned about trying to strike a deal with Donald Trump only to be embarrassed. Look at the Oval Office meeting with Zelensky last week. If you are a foreign leader, you say, do I actually respond to these, and how aggressively do I respond to these? Or if I get to the White House, I think I have a deal, and it just devolves from there. That's a real concern globally.
Ed, has there been a shift in tone from your clients in terms of their belief in just this being sequencing, that the hard stuff comes first and the good stuff comes later?
So I'm right now at the Raymond James Institutional Investor Conference. We have over 1,000 companies and investors, and every single conversation I had last night was, is this going to be worse than we expected? We don't have a lot of conviction. There is a lot of angst out there. You go company by company. They haven't really disclosed exactly what the impact for them, oftentimes because they did not think this was going to happen. And so that uncertainty is a huge shift in tone. That kind of concern that this could last is a huge shift in tone. They're hopeful that this comes off, and I think the base case is that 25% on Canada and Mexico does not last for very long. But as soon as that gets pulled off, what happens with Europe? What happens with the rest of the world? Those concerns, which were kind of completely pushed aside, Lisa, are front and center in every conversation I'm having right now at our Raymond James conference.
Ed, how much at those dinners were people saying that they just are putting everything on hold? This is just a time to wait and see, and any plans for investment, any plans for deals are just going to have to wait until there is some more clarity.
Yeah, I think for investors, most need to be fully invested. So they are trying to figure out where they can hide. What are the opportunities for them to not get kind of hit by a buzzsaw on transactions and M&A, on IPOs? That is a lot more frozen or sluggish than expected. And that was a big theme as well in my conversations, like what was expected after November and into December and that euphoria. People are like, we need to understand where rates go, where tariffs go, what tax policy is. The long list of Trump concerns is the new conversation I'm having with clients at Raymond James.
It's a big change from where we were a few months ago. Ed, appreciate your time, sir. Thank you. Ed Mills there of Raymond James. We came into 2025 and confidence was sky high. And we said on this programme that we wanted to see that translate into hiring, translate into investment. For a lot of people running companies right now, they believe the prudent decision is to do nothing. And doing nothing is showing up in the economic data. Inertia is there for all to see.
And that seems to be what we saw in some of the ISM manufacturing data, and the reason why the services data tomorrow is going to be so important. We've been talking about how there's this huge gap between consumer spend sentiment and corporate sentiment, and corporate sentiment has hung in there. Until now? I mean, that's sort of my question. Has that started to really genuinely shift?
Depends how long these stay on.
Yeah.
And we'll be playing that game day by day, week by week, month by month. Equity futures right now, the S&P 500 negative by not even 0.1% following the biggest one-day loss of the year so far. Up next on the programme, Sucharita Kodali of Forrester on the outlook for retailers. From New York, this is Bloomberg. So this time yesterday, we had an equity bounce, and that bounce collided with weak economic data and tariff headlines. Then we got the biggest one-day drop on the S&P 500 of the year so far. Equity futures this morning, no bounce. We're negative by 0.05% on the S&P. On the Nasdaq, almost totally unchanged. In the bond market, check out this run at the front end of the curve. 8 consecutive days of lower yields. That's the longest run since March 2020. When you see runs like that at the front end of the curve, it usually means great things aren't happening in the US economy. And this is off the back of weaker than expected economic data and the expectation there is more weak data to come. I want to finish on the commodity board. I want to talk about crude, both Brent and WTI, near the lows of the year. OPEC Plus talking about reviving output. We're lower again today. WTI with a 67 handle.
So they're putting more barrels on the market. We haven't seen this literally. There's been a hiatus of this for 2 years, and a lot of analyst notes are coming out. Halima Croft of RBC today, OPEC quick take, playing it safe. Playing it safe with who? The President of the United States in the Oval Office, Jonathan.
That's the latest on crude, 67.69 on WTI. On our radar this morning, our top story, Canada and China slapping retaliatory tariffs on the United States. Canada hitting back with phased levies of $107 billion of US goods. China imposing tariffs as high as 15% on agricultural shipments.
So everyone's going to say, all right, we have the retaliatory measures in effect, at least for 2 of the 3 that Trump put higher tariff thresholds on last night. What happens now at Mexico? We're going to be awaiting this very anticipated speech from the president. I'm interested in when it comes to China. Bloomberg Economics makes a very good point. When it comes to China, these targeted tariffs on things like soybeans, on cotton, on chicken, on beef, that might hit the President of the United States in the heartland where he has his base. And that could become a political problem for him.
I was struck by this study by the Budget Lab at Yale University that showed that the effect of the new tariffs on Mexico, Canada, and China is the equivalent to a 7 percentage point hike in the U.S. effective tariff rate, taking us back to the highest levels not seen since 1943.
Steve Cohen was super bearish compared to how constructive he has been over the last few years. He said this was the first time he was negative in quite a while, said the tariffs are taxes, said that Doge was austerity, and that was basically the why.
And people are saying maybe longer term there will be a rejiggering of the world order and more domestic production. But how long will it take before that shows up in more positivity?
When it comes to that Budget Lab, they said that all these tariffs could mean $2,000 more in each U.S. household. Scott Bessent over the weekend, the Treasury Secretary, was talking about appointing an affordability czar. What do you think the first thing that affordability czar is going to give to the White House as one measure they can use to lower the inflationary and cost concerns for American consumers?
When the cost of living crisis really kicked in this country under President Biden, there were a lot of questions about whether the administration would remove tariffs, never mind put additional ones on. Ultimately, they decided to keep the tariffs on China. But that conversation certainly started over at the White House.
There is a sense that maybe there is a reprieve down the line. The question is, no one has a real sense of why these tariffs exactly are being used. Are they for national security? Are they as a cudgel for fentanyl? Or are they going to be to bring back domestic production? Until you know that, it's hard to know exactly what kind of negotiating tool they are.
That's the latest on trade. This is the latest on foreign policy. President Donald Trump pausing military aid to Ukraine. A Defense Department official telling us here at Bloomberg that Trump is waiting for Ukrainian leaders to show a good faith commitment to peace.
So this doesn't include the weapons that are in Ukraine, but any weapons that are in transit on aircraft and ships or waiting in transit as well in Poland, they are going to get this pause. Andrew Bishop sent out a note last night over at Signum. He said this was not the administration's maximalist option. The real tool to harm Ukraine would be cutting it off from intelligence rather than weapons. Clearly, though, Donald Trump, the President of the United States, is taking one more hit to Zelensky potentially to try to drive him to the negotiating table because they were not happy with what happened in that Oval Office.
This just catching my eye as well. I wanted to bring this story to you. Target numbers just crossing the Bloomberg, projecting little to no sales growth this year. coming in below estimates in terms of guidance on Wall Street. The company warning of meaningful pressure on profit, citing weak February sales and uncertainty around consumer sentiment and tariffs. Compare the outlook to the actual numbers in 4Q. 4Q numbers, EPS and sales coming in a little bit better than expected. So a beat to the upside for the actual numbers, Lisa, but in terms of the guidance, a downside surprise. As for the guidance, how much weight can you actually put on the guidance from a retailer at the moment?
Well, this is exactly what people are saying, that this is a whole bunch of lowering the bar to try to exceed that bar later on. That said, they talk about meaningful pressure on profit in the coming months. With weak February sales, they attribute it to cold weather. I never understood this. Cold weather prompts people to buy jackets and gloves. When it's too warm, they don't buy those. They always complain. But also uncertainty around consumer sentiment and tariffs. Consumer sentiment is going to be key in terms of the connection between what we're seeing in some of these surveys and how that plays out at retailers.
Target this morning in the pre-market positive by 0.6%. To extend the conversation, to stick with retail, Sucharita Kodali of Forrester joins us now for more. Sucharita, welcome to the program. Target just about unchanged in the pre-market. Got a bit of tension between the numbers and the guidance. How much weight can we put on the guidance at the moment?
Well, I think the guidance is what has been driving a lot of these retail stock prices. We saw the exact same situation with Walmart the other day, where their overall numbers for Q4 were strong, but they too projected weak guidance. And if Walmart's numbers were going to be weak, it was going to be almost a foregone conclusion that Target was going to have a similar outlook. Target is a distant follower in the mass merchandise space. It did really, really well through the pandemic, but has essentially struggled since then. So it's not surprising to hear what we did today. But I do think that, to your points, exactly what was said about tariffs and consumer sentiment are the big issues that are likely going to be depressing most retail stocks for the weeks and months to come.
Do you think tariffs are a convenient scapegoat for a slowdown that had already started? Is there something else going on here?
Well, the tariffs absolutely are going to affect retailers to the negative, because a lot of these tariffs are affecting consumer goods. You have agricultural products in Mexico. You have from Canada, we have input costs, whether it is lumber or fuel, that are likely going to go up in price. And then you, of course, still have quite a bit of manufacturing, particularly in consumer electronics in China. And these are all consumer goods. So this is absolutely going to affect retail. Is it going to crush the retail industry? Most likely not, because it's going to be on a portion of goods, but it's going to be really difficult for the year 2025. And we really need to wait and see what is the purpose of these tariffs. And, is this political theater, or is this really intended to bring manufacturing back to the United States and reduce the current account deficit?
Sucharita, are we underestimating or overestimating how much these companies can pass along price increases to consumers?
Well, it's going to probably be, to some degree, inevitable that consumers are going to have to face some of the price increases, particularly when you're looking at agriculture and the grocery sector. The grocery sector just simply doesn't have the margin to be able to absorb all of it. So there's definitely some that will be passed on to consumers, but in some cases, you may see some of it being absorbed by companies over time. If you look at a consumer electronics manufacturer that's very profitable, like Apple, they may be able to absorb more than, say, for instance, a grocer.
There's also a question about inventories, and we raised this before the earnings call, and I'm looking right now that really not seeing a lot of insight into just how much they're adjusting their inventories to deal with what's coming down the pike. What are you hearing, though, about other retailers and how they're adjusting to try to be a bit proactive?
Well, it seems that what we learn from history is that we don't always learn from history. And what we saw during those supply chain crunches in the last few years was that we should be having more resilience in our supply chain. But it's not clear that companies have necessarily managed to have more flexibility, whether they've diversified their supplier base as much as they could or should. We have seen some offshoring and some nearshoring to reduce some of the dependency on China. But for the most part, we still have single nodes of supply, and in order to keep prices down, and that's something that if that single node happens to be in China, Mexico, or Canada now, that's problematic.
Sucharita, what did these corporations and retailers learn from Trump 1.0 when it comes to trade war?
Well, I think that there was wishful thinking that there was more talk than action. So I think that that's really what perhaps some of the optimism, or the continued optimism that came through his election was really about. Was the hope that it wouldn't affect their industry, or that it was just simply a negotiating tactic. And what we see now, it's still very early days, and what we know is that there's still a lot of uncertainty, and things change very quickly in a Trump administration. I mean, we may have tariffs this week, and it's very likely that in the next few weeks things could be completely different. And I think that's what's adding to the volatility and the uncertainty in the market, is that all we know is what has been announced, and the downstream effect on businesses and the downstream impact on their pricing is still to be seen.
Based on these headlines and this guidance, is this company effectively conceding? Is Target conceding they can't pass on higher costs to the consumer anymore? Is this a change compared to where we were a few years back?
Well, it is certain that's actually been the case for some time, where the consumer sentiment is largely tied to inflation levels and is largely tied to those higher prices. So I think retailers for some time now have realized that they have limited ability to pass price increases, particularly for consumables and commodities, onto shoppers. So the bigger question, though, is whether or not Target believes that the U.S. economy is going to be resilient over 2025. What we saw over the last few years is retail spending has still been very, very strong, even in spite of low consumer sentiment. And what is different now is retail spending may actually be down in lockstep with consumer sentiment, and that's not a good thing.
Target, just about positive in the pre-market today. Sucharita, Kodali there at Forrester on the latest. Target coming out with numbers looking for flat sales this year, warning about pressure on profitability and citing risks from trade tariffs. Trade tariffs in front and centre for the story so far this morning. Within that, there is somewhat of a concession that we're not in a position to pass on higher costs to the consumer like we were a number of years ago.
And that seemed to be something that we're hearing across the board, that essentially you're not going to get the same type of price hikes. That said, there are questions about just how much they can pass along, and where I do want to put into perspective that Target shares are down about 10% so far this year. So if it is bouncing a little bit today, maybe it's on a bit of a relief rally that they posted better than expected fourth quarter earnings.
Down yesterday as well, off the back of those trade headlines. Equity futures right now on the S&P 500 down as well by about 0.1% on the S&P. With an update on stories elsewhere with your Bloomberg brief, here's Yahara Hackers. Hey, Yahara.
Hi, John. Recapping those earnings, Target delivered a disappointing sales outlook for 2025. The retailer expects comparable sales to be flat this year, falling short of what analysts were expecting. Meanwhile, net sales are expected to climb around 1%. The company also warning of meaningful pressure on profit in the coming months, citing uncertainty around consumer sentiment and tariffs. But as you said, shares are higher in the pre-market. Meanwhile, China's biggest political event of the year is underway. President Xi will unveil the latest stimulus plan for the country at the National People's Congress. Thousands of delegates and leaders are expected to push China's official budget deficit target to its highest level in over 3 decades. This comes, of course, after President Trump slaps an additional 10% tariff on the country. And we end with the latest on the Pope. This morning, the Vatican is reporting that Pope Francis slept well through the night after they said yesterday that the Pope had experienced 2 episodes of acute respiratory failure. His Holiness has been receiving treatment for bilateral pneumonia at Rome's Generale Hospital since February 14th. That's your brief. John?
Yahara, thank you. Appreciate the update. More from Yahara in about 30 minutes' time. Up next on the program, U.S. commodity dominance.
We've got this window, this wonderful gift, quite frank, that the shale industry gave the United States, which is we went from being the largest importer of energy in the world to the largest exporter.
That conversation up next with Daan Struyven of Goldman Sachs from New York City this morning. Good morning. Waking up to 25% tariffs on Mexico, on Canada, an additional 10% on China. Equities yesterday, the biggest one-day loss of the year so far. No bounce this morning, so far at least. Equity futures just about unchanged. In the bond market, yields higher by a single basis point. 10s at 416. In commodities, crude, new lows for 2025. We're down by 1.26%, 67.50. Under surveillance this morning, US commodity dominance.
We've got this window, this wonderful gift, quite frank, that the shale industry gave the United States, which is we went from being the largest importer of energy in the world to the largest exporter and in energy self-sufficiency for a period of time. And so that's a window, though, that won't last forever.
So here's the latest this morning. Oil falling as OPEC Plus moves to revive halted production amid pressure from President Donald Trump to lower prices. Daan Struyven of Goldman Sachs writing commodities are front and centre in President Trump's trade and foreign policies as his administration pursues US commodity dominance, spurred by competition with China. Daan joins us now for more. Daan, good morning to you.
Good morning.
What happened in Riyadh a few weeks ago between three of the biggest exporters and producers of US crude on the planet?
So yesterday, OPEC decided to raise production in line with their announced schedule, but against consensus expectations. In our view, this primarily reflects two factors. Number one, inventories have fallen. You're actually at the lowest level of global commercial inventory since mid-22. Second, I think since last summer, when OPEC announced its data-dependent plan, I think the group is shifting the market modestly to an equilibrium where OPEC is really controlling spot balances, reducing volatility, to now a situation where they're also discouraging supply growth and supporting internal cohesion, making sure that compliance with those cuts is strong enough. We think those are the two key drivers here.
You managed to offer an explanation without mentioning the President of the United States. I tried to take you there. I'll try again. Has President Trump got a role to play here?
So as I said, I think there are more important drivers that I just sketched, and I would bring in two additional points of context. Historically, there have been instances where clearly publicly the US president has discussed oil policies with Saudi Arabia and Russia, for instance in 2020 and also in 1986. But actually in both instances, the problem was that prices were too low for the US producers. We think that the current price levels, and we still look for Brent in sort of the high 70s, TI in the low 70s this year, we think current price levels work reasonably well, both for the US consumer, US producers, and for Saudi Arabia and Russia.
Right now, though, he wants to get energy prices lower, bring down the cost of oil. He told OPEC Plus last month. How does he work on bringing down the cost of oil, but at the same time meeting Scott Bessent's long-term plan for 3 million barrels more coming out of the United States? What's the price point that is basically worthy of American consumers, but also corporations to want to keep drilling?
Yeah, so exactly. We think that current price levels are still essentially the sweet spot where you have both affordability, because US consumers start to really focus on US gasoline prices. You see really a spike in US gasoline media mentions once you're above $3.50 per gallon for US retail gasoline prices, which is mid-80s for Brent. We're still below that. And on the producer side, we find that US crude supply growth slows down more meaningfully when prices drop into the 60s in Brent terms. And we're still slightly above that level. So we think we're still in a sweet spot. At the same time, I think you're right that some key members of the administration, like the president, seem to be publicly a bit more focused on the consumer side, on the affordability side. At the same time, I think that other members of the administration also emphasize the key need for stronger US exports, which is a source of economic and geopolitical power, which in our view requires prices not to draw much further from here.
What's going to be the impact of this 10% tariff on Canadian crude?
So if it becomes confirmed, we think that the burden of a 10% tariff on Canadian crude would be borne both by Canadian producers, because you would see a sharp discount in Canadian crude prices on the one hand, and on the other hand, the U.S. consumer, where we would expect a pickup in U.S. refined product prices. I think the key reason a large share of the burden, about 3/4, would fall on Canadian producers is that there are not a lot of alternative outlets for these Canadian barrels. There are constraints in terms of pipelines and other export transportation mechanisms, and so those Canadian producers would likely be forced to discount their barrels to make sure they can continue to go to Midwestern refiners.
We're hearing some tough rhetoric coming from Canada. The Ontario Premier is talking about willing to do anything, even cutting off energy. What would that do to these refiners in the Midwest?
So we think that U.S. Midwestern refiners are really set up to use those heavy Canadian barrels. At the same time, I think they have some bargaining position vis-a-vis the Canadian producers, who also have limited alternative options.
In the past, there have been allies and there have been rivals when it came to the oil patch. Are those alliances shifting in a way that could potentially shift the levers that you have to watch as you determine what the calculus is behind whether production increases or decreases?
So we think that the key data points to watch from the U.S. perspective are the U.S. cost curve, where production growth should be solid when you're around current price levels, but where you can't really afford to fall a lot lower in terms of prices. And then, of course, U.S. retail gasoline prices, which could be affected by global crude prices, but also by tariffs.
Well, what I was trying to get at is, in the past, it was the U.S. over here versus OPEC, and Russia and Iran and Saudi Arabia kind of negotiating and haggling within themselves and seeing the United States as the big bad wolf over here producing without any constraint. Has that dynamic shifted fundamentally in a different way?
We think there have been instances in the past where Russia, Saudi Arabia, and the U.S. Discussed global oil markets and discussed what are possible price levels and possible policy levers. In 2020, President Trump publicly tweeted that he convinced OPEC Plus to cut production to prevent prices from really leading to significant U.S. drops. In the mid-'80s, when Saudi Arabia was incentivizing its partners to improve compliance by raising production, the U.S. administration was also discussing oil market policies. And so if we were to see discussions between Saudi Arabia, Russia, and the U.S. on oil markets, it wouldn't necessarily be such a break from historical patterns.
Let's finish on metals. A week tomorrow, I believe, 25% tariffs on steel and aluminum. What's the base case for you and the team?
Yeah, so we incorporate that you have 25% tariffs on steel, aluminum, likely also later copper. What are the implications? We think higher U.S. prices for metals, with pretty much 100% pass-through to the U.S. prices of steel, aluminum, and copper, if we get it. The production effects would be more mixed, with some meaningful upside over time to U.S. Copper production, but pretty limited effects, for instance, for aluminum, where access to power, cheap power contracts is a challenge to restarting production significantly at higher levels.
Dan, appreciate your time. I'm sure you're busy. Everyone is at the moment. Dan Struyven there of Goldman Sachs. The tariffs go on this morning. 25% tariffs on Mexico, on Canada, an additional 10% on China. And next week, tomorrow, we're going to get potentially, according to the team at Goldman, 25% on steel and aluminum as well.
Which is the reason why people are looking at autos in particular to see whether this is going to hit them in a double whammy on all sides, whether it's the input production costs or just simply where components are coming from, i.e. Mexico, i.e. maybe somewhere else too.
GM down yesterday, but not doing much in the pre-market. The autos so far in early trading at least, doing okay. We'll see how that picture changes through the hours still to come. Up next on the programme, the second hour of Bloomberg Surveillance, we'll catch up with Stuart Kaiser of Citi, Don Schneider of Piper Sandler, Kit Juckes of SocGen, and the former NEC Deputy Director Everett Eissenstat. That and more still to come.
tariffs are looming over the market.
We see quite a big hit from the tariffs of about 1 percentage points on growth. That would be a disaster.
The likelihood of tit-for-tat retaliation is definitely something that we need to worry about.
I think there's going to be some issues for the consumer.
I think that's the thing we're going to live with for the next few months, if not next few years, which is multifaceted trade policy.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now, so let's start with the scores. Equity futures on the S&P 500 down by a little more than 0.1% yesterday. Down by almost 2 percentage points, the biggest one-day loss of 2025 so far. In the equity market, looking at the Nasdaq, down by a whole lot more than the S&P yesterday. This morning, just about unchanged. This morning, waking up to a new dawn for global trade. 25% tariffs on Mexico, on Canada, an additional 10% on China.
People who thought this wasn't going to happen have received maybe a cold dose of reality at the same time. It seems like that reality is now just wait and they'll be taken off soon enough. A question here really is how much are we seeing a downward move in markets because of the growth data that we could be getting or because of the policy mix? Parsing out those two getting increasingly difficult.
The path forward is unknown. What we do know is that there's now tit for tat. Canada has announced tit-for-tat measures, retaliatory measures to these tariffs. China has as well. We're just waiting on Mexico to see exactly what the president there wants to do. They have an A, B, and C plan. Canada's immigration minister said this: it's a moving target, and that's frustrating. The same people who didn't know whether or not these tariffs would come on also don't know potentially when there could be a relief valve.
There is a distinction, though, to draw between what everyone's saying about markets and what markets are actually doing. And I'm talking about stocks. Stocks are still only 5% away from all-time highs. It's a 5% pullback. Just think about that. In the context of all the doom and gloom of the last few weeks, we're only down by 5%. So either you think that sentiment has got to catch up or this market's got to catch down, but something's got to give here.
Well, something's got to give between the fact that when we talk about sentiment, who are we talking about? Are we talking about one another? Are we talking about consumers? Are we talking about corporate executives? Because frankly, you heard David Solomon of Goldman Sachs yesterday come out and say he still sees the chance of a U.S. recession as fairly slim. You know, Steve Schwartzman, similar kind of tone. Yes, these are people who have to run big businesses and are still investing. So at what point does the negativity that we're seeing among consumers bleed into the corporations that have to make these big decisions?
It's not their baseline, but the chances of it happening aren't zero, and the chances went up off the back of the economic data we've seen so far. Just remember, we came into 2025 with confidence sky high for consumers, for businesses alike. And we were hoping they were going to do all these great things, invest and hire. And now we're starting to sense some inertia. I think we could sit here all day and talk about whether the tariffs stay on, the kind of impact it will have. It's already in the data. We're already seeing it in confidence. You're already seeing it in the ISM manufacturing.
ISM, if you look at those write-ins, overwhelmingly, it was about tariffs and those concerns. There's also something else. Is Trump 1.0 the same as Trump 2.0? In the sense that Donald Trump used to always quote and look at the stock market, the Dow Jones, and that used to be for him a reflection of his policies and his administration. Are they doing well? Mike Wilson sat around this table and said, have you seen many truths about the stock market lately? You haven't. Does he care as much? Is that going to be a check on some of his policies?
Just where is that Trump put? Equity futures right now in the S&P negative by 0.2%. Coming up this hour, Stuart Kaiser of Citi on a brewing global trade war. We'll speak to Don Schneider of Piper Sandler as President Trump delivers on tariff threats and the former NEC Deputy Director Everett Eissenstat warning of choppy waters still to come. We begin this hour with stocks looking to recover after the worst sell-off of the year so far as trade tensions continue to escalate. Stuart Kaiser of Citi is watching consumer sentiment, writing tariff headlines alone are not insurmountable. The pass-through to consumer confidence is the issue. That process has been stronger, faster and more dramatic than anticipated. Stuart joins us now for more. Stu, good morning.
Good morning. How are you?
I'm all right. Do these tariffs make it a whole lot worse?
You know, the tariffs matter, but again, I think, as you all mentioned, it's the pass-through to economic data, and I think actually more importantly for equity markets, we've seen a pullback in retail investor sentiment. We've seen a pullback in the inflows into U.S. equity markets. So you kind of entered this year with a really strong foundation in markets from earnings growth and GDP growth and a supportive Fed. You had really big risk reward from policy and things like that. when you start to see the economic data, kind of wobble a little bit, now you're talking about how firm is that foundation. So I think it's kind of a different game we're playing now, and I think it's a lot more risky than what we had, a month or two.
When do interest rates start to provide some support? You've been pretty consistent on this. You wrote in your recent piece, we continue to see a 3 handle on 10s as worse for equity markets than a 5 handle, given the data required to push yields down to those levels. When does that mood start to change on that front?
I think it's going to take a bit. I think you're probably going to need the Fed signaling that they feel like they need to come in and cut rates to support the market. And I don't think we're anywhere, near being there yet. So I think just the 10-year yield moving lower, particularly to your point, if it's coming from weaker growth data, is not really a support for the market. I think you would actually need the Fed to come in and sort of acknowledge that they're a little bit concerned with the economic data, and that they maybe, want to provide some policy support. The fact is, though, equity markets are going to be a lot lower if that eventuality happens. So I think that's kind of a be patient and wait for that to happen. You don't want to kind of pre-trade that.
John was talking about how the market's only down about 5%, even though sentiment evidently is rock bottom among a lot of people. How do you explain that differential?
Look, I think consumer sentiment is a survey, same as ISM is a survey. We're going to have to start to see it, I think, in the hard economic data. If you look at Atlanta Fed GDP, that has come off. The PCE data last week was weak. So I think the dislocation here is, consumer sentiment. I think we need to see that flow through, probably to the labor market. Our general view has been the unemployment rate is the single most important data point that matters. That means Friday is super, super important. So, I think it's early stages. As we talked about earlier, in August of last year, you did have a kind of wobble in the data already. The market's been fighting off kind of recession talk now for 2 or 3 years. So I think there's a little bit of a once bitten, twice shy on that as well. So I think we're a little bit early stages. We're going to need to see that consumer data kind of flow into actual real labor markets.
In previous downturns that were often credit driven, high yield bonds were a tell. Credit spreads were a tell. I'm wondering how much the script has shifted, because this isn't going to be any kind of credit driven sell off. It certainly isn't right now. How much are the financial stocks the tell in terms of that bet on mergers and acquisitions and deals activity continuing to flow through?
It's a great question. I think the reason the credit market isn't the tell right now is because corporate balance sheets are healthy, right? This is an issue of U.S. government debt. So I think if you were to see the bond market impact equities, I think it's going to come from either the 10-year down on growth risk or the 30-year up on inflation and deficit spend. So I think that's the difference between, let's say, today and back in 2009. It's who owns the debt. And right now it's kind of held by the government. Financials is a good question. I mean, we like M&A targets as a theme. Those stocks have performed absolutely horribly, to your point, because that's a risk-on sentiment, kind of trade. So financials have been totally Teflon, frankly, for the last 3 months. The market sells off. There's a bid below on those stocks consistently. Financials were up over 2% last week. So I think if you were to see financials sell off here, that tells you, I think, that institutional investor sentiment has declined. And that'd be definitely a red flag for the market.
How much is the market earning for the other part of Trump's policies, the quote unquote good stuff, the tax cuts, which potentially might not get to the very end of the year?
I think it's a great question, because back in 2017, the order was flipped, right? We did the good news on the taxes first. We did the bad news on the tariff second. Now we've kind of flip-flopped that. In my view, honestly, the next month is going to be very interesting. If you look at the House's resolution 2 weeks ago, $1.5 trillion of spending cuts, $4.5 trillion of tax cuts. That is a $3 trillion gap that kind of needs to be dealt with, right? So I do think the budget and deficit headlines, particularly over the next kind of 4 to 6 or 8 weeks, are going to start to really matter, because Trump does not want to leave this until December, right? He wants these deals done now. And as you know, I think once a congressional budget office or somebody scores some of these things, it's going to look kind of ugly, from a deficit perspective.
And in between all that, potentially we're looking at a government shutdown next week. You mentioned the fact that the Fed is going to be focused on unemployment. We have a jobs number this Friday. We're looking at 160,000. What kind of number do you think there needs to be for the Fed to maybe bring up the thinking that they're going to have to cut sooner?
I think we're a long way away from that, to be completely honest with you, just because with the unemployment rate at 4 and having declined the last couple of months, they're probably feeling pretty good about things, from a labor market perspective. The type of data on Friday that will get you concerned will probably be you print, kind of low 100K type numbers, 125K, let's say, and you actually see the unemployment rate rise. Consensus, to your point, is at 160 with the unemployment rate staying at 4. I think if you saw like a 4.1 or a 4.2 on the unemployment rate, people step back and say, oh, Now this consumer confidence stuff is actually appearing in the labor market data. So I think risk reward around Friday is pretty poor. If you print a strong number, it's going to be, yeah, but if you print a weak number, it's going to be, oh my goodness, they've actually managed to really, hurt the labor market in a rapid fashion.
The Fed knows how to respond to, oh my goodness, though. They know what to do. You cut interest rates. What they won't know what to do, what will be a bigger struggle, is stagflation. The Target CEO was speaking to the American media just moments ago and said that price hikes in coming days could be coming due to tariffs. Lisa, the pass-through to the consumer is the biggest question we've got to ask here this morning. 25% on Canada and Mexico, additional 10% on China. Are we in a different place? Are they able to pass on those costs to the end consumer? If they try to, do they get pushback? What does that mean for top line and bottom line growth going forward from here for a whole bunch of companies?
Is it going to be this idea that people are dealing with higher prices at the stores? Is it going to be that stock investors are dealing with just profit margins that are compressed across the board? Or is it, yes, that essentially there's going to be a little bit of both, which seems to be the consensus?
Stu, when you sit down with the economics team at Citi, Andrew Hollenhorst and everybody else, what do they say about that?
Look, I think the risk on the econ side, which is what you described for the Fed in particular, is you've got Doge / expense cuts that are negative for growth, and you've got tariffs that are stimulative on the inflation side. So it kind of attacks them from both sides of the dual mandate. So I think economists are looking at this, and that's what you're trying to figure out. I you have to have one egg for breakfast instead of two, John, and it's...
Am I cutting back?
I don't know how many eggs you eat, but...
Never just one.
No?
That never makes sense, just one egg. I mean, who has just one egg?
This has to be bad for the GLP-1 theme, right? People eating less eggs. So
one egg is kind of sad.
It is a sad breakfast.
I'll cut back elsewhere. Stuart Kaiser Citi there. Who has just one egg?
Well, only if it's an adornment for a dish. Then you can have one egg.
Okay, sure.
But other than that,
like a poached egg on something.
Correct. Like on avocado toast, that makes sense. But one egg by itself.
It's got to be like minimum 3.
Yeah, I would agree with that.
Well,
yeah. Minimum 3.
Minimum
that means
3.
Minimum 2 because it's 2 pieces of toast. I think that's fair. Minimum 3 if you're,
It's the first world problems, aren't they? How many eggs are you eating? Let's give you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara Hacker. Say, Yahara.
Hi, John. We start with Best Buy. Those shares are rising 2.7% in the pre-market after its fourth quarter comparable sales beat estimates. The retailer also bumping its quarterly cash dividend a cent to 95 cents per share. Best Buy expects consumers will remain resilient, but will be more value focused as high inflation continues to weigh on them. Meanwhile, Aramco shares are lower after the Saudi oil giant slashed its dividend in a bid to ease stress on its finances. Payouts will amount to $85 billion this year, down from $124 billion in 2024. Aramco also reported weaker earnings due to weak oil prices and production near the lowest level in more than 3 years. And nearly 100,000 California workers are ordered to return to work by Governor Newsom. Starting in July, state workers will have to return to their offices 4 days a week. California's 224,000 workers are currently required to go into the office at least 2 days a week, with many already required to be full-time in office. That's your Bloomberg Brief. John?
Yahara, thank you. Every picture I see of Governor Newsom, the governor of California, always looks so happy with himself. It's like every single picture.
He's got very good hair.
He's got that Hollywood thing going.
Got a new podcast out now, too.
He just looks so happy every time I see him. Getting some headlines here I want to share with you just briefly. Things have changed at the Federal Reserve so quickly. Only a few weeks ago, on this program, we had guests talking up the potential of rate hikes and not rate cuts. And now all of a sudden pricing in fully 3 cuts for 2025. The next meeting 2 weeks tomorrow, March 19th. That meeting for this Federal Reserve is changing very quickly. 2-year yields down for 8 consecutive sessions. We're down 4 to 390. Up next on the program, following through on tariffs.
On the tariffs, is there any room left for Canada and Mexico to make a deal before midnight? And should we expect those Chinese tariffs, the extra 10%, to take?
No room left for Mexico or for Canada.
Waking up to 25% tariffs on both of those nations. In just a moment, Don Schneider of Piper Sandler joins us next from New York City this morning. Good morning. Down hard in yesterday's session, just beginning to drop a little bit this morning. We're down by a third of 1% on the S&P 500. In the bond market, yields lower again. We're down by a single basis point on 10s, 4.14.17. Other surveillance this morning following through on tariffs.
On the tariffs, is there any room left for Canada and Mexico to make a deal before midnight? And should we expect those Chinese tariffs, the extra 10%, to take effect tomorrow?
No room left for Mexico or for Canada. No, the tariffs, they're all set. They go into effect tomorrow. China also had an additional 10, so it's 10 plus 10.
So here's the latest. President Trump hitting Canada and Mexico with 25% tariffs and doubling the rate on China to 20. Canada and China responding with retaliatory levies, and Mexico's president set to speak later on this morning. Bloomberg's Tyler Kendall joins us now from Washington. Tyler, let's talk about it. This is what's on the table now. Over the next few weeks, there could be more still to come. What's on the table over the next month?
Right. Well, John, Ed Mills of Raymond James told you on this program last hour that we are expecting this steady drumbeat and that moving the tariffs up and down is all just part of that negotiating process. When we look at the calendar, March 12th, that's when we are expecting additional tariffs on aluminum and steel that could particularly impact Canada and Mexico. April 1st is when we are expecting Commerce and USTR to unveil their reciprocal tariff plans when it comes to their country-by-country calculations. Those could then go into effect on April 2nd, along with a whole host of tariffs on additional goods, including pharmaceuticals, autos, and chips. Of course, though, this is going to start to be a tricky needle to thread for this White House when it comes to messaging to the American consumer. I actually spoke to one Republican congressional aide earlier this morning who told me that yesterday they saw calls starting to surge to their local offices, not necessarily their Capitol Hill offices, which I thought was interesting. Their local offices embedded in these communities where constituents are asking how tariffs are going to impact inflation, particularly after that preliminary report had come out that Beijing indeed was looking at targeting those U.S. agricultural products. This Trump White House has really campaigned on bringing down costs for American consumers. And if you ask any senior administration official, they're going to tell you that it's against this backdrop of a broader macroeconomic plan that will help to offset these concerns. A big part of that, of course, John, is President Trump's tax cut agenda. He views these tariffs as a revenue raiser, but important to keep in mind that fiscal hawks on Capitol Hill are already starting to raise concerns about making his 2017 tax cut plan permanent.
Tyler, when it comes to messaging, how difficult is it going to be also for Trump's cabinet? Howard Lutnick, the Commerce Secretary, was saying this was a fluid situation, and he sort of signaled that there would be tariffs, but they may not be as high as 25%. And then Donald Trump said, nope, no more room to negotiate.
Right. It's showing us that this is really a process that is evolving as it speaks. Right. We were looking to see if perhaps our reporting that had indicated that we had asked Mexico and Canada to up their own tariffs against China. It's going to be a fluid conversation going forward here. But as we are seeing, and you've been discussing all hour on this program, the consumer sentiment data, Target also in terms of its sales growth forecast, it's all going to end up coming back to the American public and how they are going to view this White House's policies going forward.
Tyler, thank you. I keep seeing phrases like wake-up call, Lisa, reality check. And then I just think of where consensus is right now. Consensus has gone from this wouldn't happen, new consensus has happened, is it won't last very long. I'm not sure that's a wake-up call or a reality check just yet.
This is sort of the wake-up call where the lights slowly get brighter, not necessarily the wake-up call that's, that kind of thing.
Is that your wake-up call in the morning?
Actually, no, I've got to say.
Super weird.
All right, let's move on.
Single egg breakfast and stranger lives.
How did you put that on me?
Dom Schneider of Piper Sandler writing this morning. This only gets harder if Canada and Mexico retaliate. The proximate issue could be fentanyl shipments. But is this really a plausible justification for tariffs on Canada? Why isn't there a clear criteria for what objectives must be met? Don joins us now for more. Don, welcome to the program. Can you answer your own question? Let's start there.
Yeah, I don't think there is a clear criteria. I think the fact of the matter here is that Trump believes tariffs are good, and he sees them as a win-win. Either you get the concessions on trade and fentanyl or other things, or the inverse, which is that you get the production that's built here, and it's an economic win. So, I think there's, in the case of Trump, he has this unique ability to declare victory at any time. I think the criteria here is relatively simple. He could declare victory on, ending fentanyl shipments, of which there were 40 pounds coming from Canada that we've caught total for relative to the 21,000 pounds we've caught vis-a-vis Mexico. So he does have the ability to declare victory at any time. But I think that the simplest solution is that he just simply likes the tariffs and thinks they will be beneficial for the U.S.
Canada's Immigration Minister Mark Miller talked about how the fact that in these negotiations with U.S. officials, it's a moving target, and that's frustrating. Do you know where the target is right now? What more concessions, specifically when it comes to Canada, this administration wants to see?
I don't think there really is anything on the immigration front. I really think it's fentanyl when it comes to the northern border. On the southern border, the illegal border crossings are well below even 2019 levels at this point. So, I think on both of those, measures, there has been success, and what more needs to be seen. I know Trump has made comments in the past, for example, saying he wants auto production back to the U.S. So, I think that's more, we're going towards that direction, that this is what this is about. This is about bringing production back to the U.S. And if I think the market reaction becomes, too painful, which at this point it isn't, then he has the ability to declare victory and roll the tariffs back and then focus on a more product by product basis, with whether it's steel and aluminum or lumber or things like that.
We've seen the retaliation from Canada and from China. What are you expecting from Mexico?
Their response has been muted so far. They've been constructive as well. I think they raised the possibility of tariffing Chinese goods. I think getting creative and, is this enough? But I don't think the nature of the retaliation would be that much different from Canada or Mexico. The goal, from Canada or China, the goal would be, target products in, say, that are quintessentially American, products that are relatively more painful or sensitive, or goods that are in, Republican districts, so that lawmakers feel pressure and apply that pressure then to Trump.
Daan, when you talk to clients, do they believe that these tariffs are going to stick?
No, not up until now. And I think it's still sort of a jump ball as to whether people believe they will stay in place. After, Trump announced these tariffs coming into effect February 4, said there's nothing you can do to change my mind, and then did not implement them, I think people started to take him much less seriously, either, thinking he had won, he got the concessions, and say, this is what tariffs are all about. You get concessions, and then the other side saying, no, he was worried about the market consequences. Either way, people did not believe these were going to come into effect. And I think in part because there really isn't a good rationale for putting tariffs on our closest trading partners. I think the reciprocal tariffs made a lot more sense, which is let's threaten tariffs on countries who levy higher tariffs on our products in hopes that both sides can lower tariffs. That is a rationale that I think makes sense. In this case, it doesn't. So I think the market participants are waking up to the fact that Trump likes tariffs, and they're much more likely to stick. But even if they do roll off in this case for fentanyl and immigration concerns, I think there's all sorts of products that Trump does want a tariff, and he does want to renegotiate USMCA. So either way, I think we will end up with higher tariffs on Canada and Mexico.
Daan, you used to be the chief economist of the Ways and Means Committee. You've seen the sausage and how it works. You've analyzed these budgets. Is there any way that these tariffs could actually be much less punitive than some people are arguing and modeling out in terms of both decreasing growth and, on the margins, at least initially, increasing inflation?
There's been some great work by the Yale Budget Lab quantifying the effects of these. So these 20% on China, 25% Canada, Mexico would be a tax increase of about $1.3 trillion over a decade. That's about 40 basis points on GDP, and would subtract, year over year, about 60 basis points from real GDP growth. So I would say the negative growth consequences in the short run from such a policy outweigh the positive growth impacts of extending the 2017 tax cuts, and even some of the kind of smaller pro-growth policies they're considering implementing in that context. So it's already kind of brings us to modestly growth negative or a wash. And, as for the deficit impact, we had a 6.5% of GDP deficit last year. These are about a 40 percentage point reduction in deficits. But of course, we're about to extend, $4 trillion in cuts and add a bit more on top. So I think it kind of leaves us with a modestly negative growth picture and then sustained high deficits.
Hey, Daan, thank you. Got to leave it there. Don Schneider there of Piper Sandler. Got to get you up to speed on a price action. This market stateside slowly waking up at the front end of the curve. Yields lower for 8 consecutive sessions. We're down below 390, 389 on twos. And traders building bets for more cuts still to come in 25. They're looking for three fully priced. Kit Juckes of SocGen up next. This market rolling over in the last 10 minutes or so, down across the board here. On the S&P 500, negative by 0.6. We're down 0.75% on the Nasdaq 100, following the biggest one-day loss of the year so far. Over in Europe, I'm looking at Germany, the DAX, still up double digits for the year, but down this morning, going into this afternoon over in Europe by more than 2%. The biggest one-day loss since 2023, potentially. The idea being, yes, 25% tariffs on Mexico and Canada. Europe, you're next. In the bond market, 2-year, 10-year, 30-year, 7 consecutive weeks of lower yields on a 10-year maturity. We could make it week 8. We're down by 2 or 3 basis points on a 10-year to 412.85. And in the front end of the curve, you'll see the 2-year on an 8-day run of lower yields. We're down 6 basis points this morning, 388.75. That 8-day run, the longest since March 2020. You don't need me to remind you what happened 5 years ago. 2 hours away from that cash open. Let's get you some morning movers. Here's Manus Cranny. Morning, Manus.
John, the risk, of course, to the exceptionalism of the US consumer. Let me take you to Walgreens. Take me private. It looks like Seymour Partners, we understand, potentially bidding $11.30 to $11.40 for Walgreens Boots. Take it private, $10 billion deal, and then break it up. Deutsche Bank said it's going to be incredibly difficult to do, complicated. Talk to you about the US consumer. Target. Solid set of fourth quarter numbers, but the actual earnings per share is down by 20% year on year. And they warn risks from tariffs, you got it, weak February sales, and the price increases are coming in the next couple of days. That is the reality of these tariffs. Next couple of days, you're going to feel it in your pocket. A cautious tone is what they're setting. Tesla, quick snapshot. China factories down, the China deliveries, I should say, down 49% year on year, down 51% on the month. That adds into the pain from Germany. By the way, 15% of the Model Y components sold in the US come from, you got it, Mexico. Jonathan.
Manus Cranny, thank you. What an ugly run for that stock after a massive run-up after the election. I want to talk about the front end of the yield curve a little bit more. Traders betting this morning that we'll get 3 cuts in 2025 from the Federal Reserve. This is an 8-day move at the front end of the curve on twos. Over those 8 days, almost a 40 basis point move lower in the past week or so.
Suddenly we went from possible rate hikes to the likelihood of 3 rate cuts. Andrew Hollenhorst of Citi Economics comes out just now and says on the margins, new tariffs are dovish for the Fed, that we expect the tariffs to essentially negatively affect U.S. economic activity, and thus the Fed will be considering that. Not March, though. And frankly, my question is, will this be enough of a support for markets to really give some boost to risk assets that are falling on the risk that this is not just some kind of negotiation?
The next meeting, March 19th at the Federal Reserve, and they've got to produce some forecast and outlook over on the FOMC. On our radar this morning, President Donald Trump imposing 25% tariffs on most Canadian and Mexican imports and raising levies on China to 20%. The president also proposing a tariff on external agricultural products as well.
So he said no room left to negotiate. Midnight came and went. The tariffs went on. 25% in Mexico, 25% in Canada. 10% we're looking at for Canadian oil. And of course, when it comes to China, an additional 20%. 2 out of the 3 have already responded. We're still waiting on Mexico's response, and I think this is very interesting because they have an A, B, and C plan, and they have done a tremendous amount of work in the past 5 weeks, flurry of diplomacy, to try to make sure these tariffs didn't come on play. Now you look at the calendar. If you were thinking these tariffs wouldn't happen, what do you think now about March 12th, about April 1st, and about April 2nd?
I just wonder how long these tariffs can remain on before there are some consequences. Even if it's not necessarily these tariffs remaining on for a long time, some tariffs are. Is there a sentiment shift in terms of buying American abroad? How does this get sort of translated into longer-term structural trade relationships? And I know it's too early to talk like that, but at a certain point, even if they come off, there are longer-term consequences that people are trying to grapple with.
Do you mean a consumer preference shift? Like what we've seen in China to some extent?
To some extent, a consumer preference shift. And then you have to imagine that companies are going to gird against that by also shifting supply chains and trying to protect themselves. But yeah, we saw that. I mean, honestly, Tesla is a sort of unique story. But we've seen this over time with Starbucks and McDonald's as sort of the templates for American consumerism. Do we see that again?
I'm waiting for the carve-outs. Wall Street Journal reporting was that Susie Wiles got on a call and addressed and reassured car makers that the administration would consider carve-outs for cars that comply with USMCA. The update, of course, to the free trade agreement during Trump 1.0. Howard Lutnick, though, made no overture. This is to their reporting. Participants left unsure what Trump would do, but the conversations has already started. So you can potentially see where the carve-outs might come to play.
We've seen limited moves in the last 24 hours in autos, and I'd also suggest we've seen limited moves in foreign exchange for the Canadian loonie and a Mexican peso as well in the last 24 hours. And we'll get to that FX conversation in just a moment. I want to get you up to speed on the latest over in Europe. The EU set to propose extending 150 billion euros in loans to boost defence spending as President Donald Trump pulls back American security on the continent. In total, countries could mobilise nearly 800 billion euros in defence spending.
So this story is not going away, especially when you have the order last night saying the U.S. military is going to put a pause on some of those weapons that are supposed to be in transit going to Ukraine. What did we hear from the incoming Chancellor of Germany yesterday? A tremendous amount, enormous amount of pressure is now on Europe to boost defence spending. And Ursula von der Leyen, speaking in Brussels, says that's just it.
This is a great time to bury bad news, so let's get to some almost terrible news. A copy-paste error at Citi, nearly transferring $6 billion to a customer's account after a staffer accidentally put the account number into a field for the dollar figure. The error was caught and reported the next business day. But this story follows on from another story we mentioned only in the past week.
Yeah, the idea of $81 trillion accidentally moved to somebody's account, and also from human error. I believe that this happened before the $81 trillion, and people were secretly relieved that this took the pressure off them because, $6 billion is a lot less than $81 trillion. At the same time, it raises the question of manual processes that could be automated, and you have to wonder how much this is going to expedite that plan.
We all want our net worth to be the length of our account number, right?
I mean,
that's the goal.
Yes, although the first, many of them, might not be numbers that you want to be in the front.
Try and figure that out. Let's turn to foreign exchange. Traders digesting President Trump's 25% tariffs on Mexico and Canada. Kit Juckes of SocGen writing this. This morning's shocker is the Canadian dollar is up. Despite tariffs arriving, Friday's Canadian jobs numbers might be important as the US wants. Kit joins us now for more. Kit, welcome to the programme. Let's talk about that muted response, if we can call it that, in foreign exchange. Kit, what gives?
Well, I mean, the big response in the sense has been this is bad for growth in the United States. And you've heard some of that. The market's pricing in rate moves that it wasn't, or more rate moves than it was, and looking negative. We have seen no shift in consensus forecast down in for US GDP growth yet. And we've seen a series of upward revisions to economists' forecasters for this year since September that drove the dollar higher. But what we're seeing is the market is going ahead away from the economists. The strategists are getting negative. The traders, the investors are nervous about what this means. So we have a weaker dollar, and that protects the Canadian dollar, where we've been talking about the tariffs for a while, and the Canadian dollar has been beaten up. But I do think it means that it puts more of a focus, in a sense, on growth in North America. What is the ISM service number going to look like tomorrow in the States? What are payrolls going to look like on Friday? And what are Canadian jobs going to look like on Friday? Because all this betting on more rate cuts faster is going to need some validation reasonably quickly to be able to sustain itself.
Kit, are you saying that people expected tariffs to be worse for the rest of the world than the United States late last year and early this year, and that story has shifted, and now people are thinking that based on where valuations are, this actually could be a bigger hit to the U.S. economic growth trajectory based on expectations than the rest of the world?
Yeah, look, I think we start from the U.S. exceptionalism position, where we've been revising up U.S. growth forecasts for a long time, revising them down everywhere else, talking about how exceptional the U.S. is, and expecting higher rates than in other places, and watching the dollar get to extraordinary heights. So we're hypersensitive, if you like, to anything that suggests that actually the U.S. economy might really be able to slow. Now, whether it's going to slow as fast or as much as people are contemplating, what you have is a big position adjustment in the market, a growing awareness of the fact that foreigners own $65 trillion worth of U.S. assets. And if they get nervous, that really is a problem. And so, these stories are beginning to happen. That the reaction in the market looks big relative to the news flow so far. But I guess that's what happens when you're at a turning point.
Kit, right now I'm looking at the euro that's actually at the strongest level going back to early December versus the dollar. Is this because of concerns about U.S. growth, or is this because of optimism if some sort of spending plan is laid out by Ursula von der Leyen today?
I mean, it's a little bit of both in the sense if you look at it, euro dollar tracks the 2-year interest rate differential painfully closely at the moment. And what's happened? Well, we've taken US 2-year rates down. So that's been the single biggest driver of that over the last few days. There is some optimism about the program. There would have been much more optimism into Europe if you'd had a sweeping win for a party in the German government elections last week. I can't remember how long ago it was now, that would have delivered an end to the debt brake that hamstrings their fiscal policy and is completely ludicrous. That would be a bigger game changer. Also, we're saying, we spent the last, 2 years in a 0.95, 113 range. Not a big range. We're just drifting up to the middle of it.
But Kit, what happens on April 2nd when potentially we get tariffs on the European Union from the United States? That 105, directionally, where does it go?
Well, I think that that's the sort of thing that can, makes me think that a move to 110 looks really unlikely, unfortunately. It anchors us. That's where we've been for a long time now, is anchored with a very cheap very cheap euro and a very expensive dollar. We get a focus on the tariffs on Europe, and we get growth concerns coming through. I think that just keeps us in a range. If I want euro dollar to go back to that 113 level, that it's the highest it's been in 2 years, I need some signs of growth, helped by easier fiscal policy, but helped by anything. I just need some growth.
What about a peace agreement? Would that do it?
Yep, that would do it. A proper peace agreement particularly if I've got a peace agreement with an agreement that we're going to do some investing, that we're going to walk back some of this ridiculously tight fiscal policy, or that would be a massive game changer. I mean, deregulation in Europe would be another game changer. But so I can see things that could change it. I do not have those yet, unfortunately.
Kit, plenty of headline risk on the horizon. Appreciate your time, as always. Kit Juckes there of SocGen. Think about the tug of war for the Europeans right now, the tension for euro-dollar. If the Germans come out and do anything like what Reuters was reporting over the weekend, we're talking $400 to $500 billion in military spending, plus $400 to $500 billion in infrastructure spending. Clearly, euro bullish. At the same time, we're talking about trade this morning and the prospect of reciprocal tariffs really, really hurting Europe as early as next month. On the trade story, this is like waking up to a fire hose of news every single morning at the moment. So we've got 25% tariffs on Canada and Mexico on most imports from those countries, an additional 10% on China, and some reaction from the Treasury Secretary, Scott Bessent, this morning, speaking to the American media just a little bit earlier, saying this on China tariffs: the Chinese export model is not acceptable. This is an argument that Secretary Bessent and this administration has made repeatedly, and I would say the president has been making consistently for the best part of a decade plus. Saying this on the manufacturers in China, though, that the exporters there will eat the tariffs. Now, we know who pays the tariffs. By definition, it's the importer. But how the cost is distributed is how we're going to have this debate around this table for the next week, month, quarter, several years. They're trying to make the argument that the Chinese exporters will ultimately be eating the tariffs.
As an explanation for why it will not raise prices for consumers and voters who said that this was their number one issue, is pretty much a cost of living crisis. It is notable to me that the emphasis is on the tariffs on China. The emphasis is not on the tariffs on Mexico and Canada. And there are some real questions what the rationale is of those, because there isn't the same kind of bipartisan support behind that as there is for China.
And this is what the Treasury Secretary has to say about Canada and Mexico. I think we're in the middle of a transition. And as you mentioned, Honda moving to Indiana is a great start. A transition means what? Potentially, at the end of the day, there will be an agreement when it comes to those trading partners.
So this is where it gets really difficult. You can be very optimistic and constructive on the Trump agenda. You can say the policy mix is still pro-growth, pro-risk, that the destination is still a favourable one. We'll get there eventually. But I think you have to concede that it takes a while to engineer a supply-side response. You can't move a factory overnight. And if you're going to implement these tariffs and implement them up front all at once, there's a price to pay in the near term. And the price to pay at the moment is on confidence. And the worry is that that confidence data will bleed into the hard data. And these are things that markets have got to adjust to every single day.
Part of the extra added uncertainty right now is we don't have a framework of where we're going. is the idea to have all manufacturing done in the United States? Is it for certain sectors? Is there a certain proportion that's acceptable and a certain proportion that's not? Are there certain trading partners that are preferable to others? And if so, who are they? Is that consistent? Is that over time? There are all these questions that are necessary to answer to even have the confidence to put parameters of how you even game this out.
The winner right now is the bond market. I'm not sure if that's by design or not, but we are rallying again. We're down 5 basis points at the front end of the curve. On a 2-year, it's a break of 390 at 389. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hacker. So, Yahara.
Hi, John. Oil prices are lower this morning after OPEC Plus announced it will increase oil production by 138,000 barrels a day in April. Plus, it plans to restore 2.2 million barrels a day by 2026. The move may be influenced by President Donald Trump's call to lower oil prices and comes despite expectations of a supply surplus later this year. Meanwhile, Russia has agreed to join the Trump administration in talks with Iran over issues including its nuclear program and Iran's support for regional anti-U.S. proxies. The issue was raised when President Trump and Vladimir Putin spoke on the phone last month. Then top officials from both countries advanced the discussions. And Chinese EV maker BYD raised $5.6 billion in Hong Kong's biggest share sale in nearly 4 years. The company plans to use the fresh capital to invest in research and development and expand its overseas business to places like Southeast Asia, Australia, Japan, and Latin America. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the programme, the trade war.
They're coming here in huge size because they want to be in the greatest market in the world, and they want to avoid the tariffs that if they're not here, they'd have to suffer.
Up next on the programme, the former NEC Deputy Director Everett Eissenstat joins us next from New York City this morning. Good morning. What a moment for the global economy, for financial markets worldwide. George Saravelis of Deutsche Bank this morning, I think framing things really nicely in the lead paragraph of his note. It is hard to overestimate the scale of change taking place in global economic and geopolitical relations in a matter of days. Waking up this morning to the reality of 25% tariffs on Canada and Mexico, in effect, an additional 10% on China. Equity futures starting to move a little bit lower. Building on yesterday's losses, we're down by 0.5% on the S&P. On the Nasdaq, down by 0.5%. Also on the Russell, down by 0.75%. Turn to the bond market. 8 consecutive days of lower yields at the front end. The 2-year back to 390. 10s getting closer and closer to 4%. Secondly, Bessent making the argument that this is what we want. We want lower interest rates. We want lower bond yields. But lower bond yields on the back of weaker economic data has been the story of the last couple of weeks. I want to finish on foreign exchange because this has been a surprise for a lot of you in the FX market. We're not seeing big moves. In fact, against the Canadian currency, the loonie here, Bramo is actually stronger, not weaker on the session, and the price action yesterday was really quite muted.
Hard to know what to do with this given how much has already been priced in, but this really shows how the narrative has shifted to tariffs maybe implying slower growth for the United States, weaker growth, Fed response, rather than just hurting everybody else.
Under surveillance this morning, the trade war.
Really, really excited. This continues the most incredible path you've ever seen in these first weeks and months of the Trump administration of incredible manufacturing coming to America. The keys that the president has called out are coming here. They're coming here in huge size because they want to be in the greatest market in the world, and they want to avoid the tariffs that if they're not here, they'd have to suffer.
So here's the latest this morning. China and Canada slapping retaliatory tariffs on the United States after President Trump delivered on his threats. Mexico's president is set to speak a little bit later on this morning. Everett Eissenstat, the former NEC deputy director, writing business must brace for unpredictable and choppy waters over the next few months as more actions are likely to come. Everett joins us now for more. So Everett, walk us through what you think happens here, because there are some people, a lot of people watching this programme right now who don't believe the tariffs that went on overnight will stay on for very long. What's your message for them?
I think they will stay on. The president had an opportunity to delay these tariffs again. He decided not to do that. And so unless there's some sea change in how Canada and Mexico are dealing with the fentanyl crisis that satisfies the president, I don't see immediate relief in the near term. So I think the tariffs are on for a bit yet.
Everett, speaking to some sources this morning, what I hear from them is they want more private sector growth, less public spending, and they want manufacturing back to the United States. But how does that work with a very intricate supply chain when it comes to an auto sector, and already that's under a trade agreement of USMCA?
This is pretty incredible, honestly. I think to see such a rapid change in the market so quickly with two of our largest trading partners is going to impact a lot of companies in different ways. And some companies may be able to absorb those tariffs or put them, distribute the costs throughout their supply chains. Others may simply not have any choice and may be forced with actually thinking about moving to the United States. And I think the president has a mindset that he's going to do everything he can to facilitate more manufacturing investment in the United States. So the tariff actions seem to be part of a larger picture of deregulation, investment incentives, and perhaps tax cuts to draw more manufacturing back to the United States. So this is the first part of a very long story, I'm afraid, but I think we're in for, as I said earlier, some choppy waters in the near term.
I was reminded by another source very early this morning that in Trump 1.0, a few months after some tariffs went on, there were exceptions. Do you expect that to happen this time?
We'll have to see. There are some products that we cannot get in the United States. We simply don't produce them. And so for those, I would think it would seem to make sense to include exceptions for those products. There's really no reason not to. But I think we'll see. Another thing to keep in mind is on top of the tariffs that went into effect last night, we've got the steel tariffs that are going to into effect on March 12th. And those are going to be broader. They're going to cover more products. They're going to be difficult to administer. And over time, as these begin to resonate throughout the economy, I think there are going to be calls for some exceptions. Even if we've got exactly what the president wanted, which is to get all manufacturing back to the United States, it simply can't happen overnight. So at a minimum, it would seem that a delay to enable some manufacturing to come back would make sense. To date, we're not seeing that, but we'll have to see how these tariffs, as they resonate throughout the economy, what kind of feedback, members of Congress get and others in the administration about how they're being implemented. I'll just note that there was as you might recall, there's a de minimis exception for products coming into the United States duty-free that they're under $800. They're able to enter the United States duty-free. The president had taken that de minimis exception away, and then when the Congress and the Customs tried to administer it, they couldn't do it. So they had to walk back from that. I don't know if we'll see something similar, but we may see that in certain sectors for certain products.
Hey, Everett, got to leave it there. It's got to catch up. Everett Eissenstat there, the former NEC Deputy Director on the trade effort in Washington, D.C. This from Mohammed Al-Arian just moments ago out on X, talking about the difference between the impact on prices, the immediate impact on prices, and the pass-through effect, the inflation effect. Talking about the gap between these two being shorter this time around. And the recent experience, the inflationary experience of 21, 22, teaching these companies in corporate America a difficult lesson, a harsh lesson, to move more quickly. And Mohammed's mentioned this a few times on this programme, that he thinks if these tariffs go on, if these companies can pass costs on to the consumer, they will do so way more quickly than they did a few years back.
They're conditioned to be flexible. How often do we hear about flexible pricing schemes and prices that can change according to the demand in real time? You have to imagine that they're going to be able to respond more quickly, and if they can pass it along, they will.
If they pass it along, then what's going to happen in the polls? This is going to be something that's going to be politically very difficult for this administration that they believe won on two issues, immigration and inflation.
Equities right now down by 0.6%. The third hour of Bloomberg Surveillance is coming up next. We'll catch up with Omar Aguilar of Schwab Asset Management, John Murphy of Bank of America on the automakers, Michael Gapen of Morgan Stanley, Jason Draho of UBS from New York. This is Bloomberg.
the idea that this tariff as a negotiating tool is too consensus.
We can talk about tariffs as much as we want, but we don't know what's going to happen.
The president seems to be far more serious about tariffs than was consensus in November when he won.
I really don't know. I don't think anybody knows but the president.
Policy backdrop is changing rapidly, and people are not sure exactly what to expect.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
I've lost count of how many times I've said this. The most fascinating time in financial markets since the pandemic. Wow. Equity futures right now negative by 0.6% on the S&P 500. We are lower by 0.75% on the Nasdaq 100. Yesterday, a bad day for equity bulls, the biggest one-day loss of the year so far, as the president says the tariffs are going on and there's no space for negotiation. They do indeed go on. 25% tariffs on most imports from Canada and Mexico. In the bond market, a bid, particularly at the front end of the curve this morning. 8 consecutive days of lower yields at the front end of the curve. We're down 4 basis points on twos, 391. On a 10-year, 415. Yields just about unchanged. The surprise in foreign exchange, the Canadian currency is not seeing a ton of weakness. It's actually stronger so far this morning. The focus of this market over the past few weeks, and you can take our opinions out of this, just as a matter of fact, the focus of this market over the past few weeks is the potential for softer growth in the United States of America. That's been the shift in the bond market.
Late last year and early this year, it was the idea that everybody else would be hurt more than the U.S. Now it's the realization that maybe the U.S. could be hit as well. People will be parsing through how much this is weakness that we saw before the tariff talk really started ramping up that we're now seeing in the data. Neil Dutta would make that point. Regardless, the focus and the bias in markets is that maybe we have overestimated how long American exceptionalism can outweigh the uncertainty that seems to be swirling over the U.S. economy.
So this is what we've got this morning, and then we can talk about what could change again in the next month or so. This morning, 25% on imports from Canada and Mexico, an additional 10% on imports from China. Then over the next few weeks, next week, 25% potentially on steel and aluminum. Then early April, we'll be talking about reciprocal tariffs. Hello, Europe. 25% on autos, chips and pharma, and throw in some ag products as well.
Absolutely, as well as lumber, as well as copper. We do have that report coming out April 1st from Commerce and USTR when it comes to unfair trade practices that they deem necessary for those reciprocal tariffs that Donald Trump, the President of the United States, says is coming April 2nd. What I find interesting about all of this is what he said yesterday. There's no room left for Canada and Mexico to negotiate. They're all set to go into effect. But the market still thinks potentially, and analysts still think, how long can this last? At some point, there has to be a negotiation at the end of the road.
At some point, there's a Trump put. Keep hearing that as well. This is a 5% pullback on the S&P 500. Lisa, 2018 was so much worse than that. This is child's play. Is that what it'll take, a repeat of 2018, to get the president and get to the other officials as well to think about a shift in policy?
He's winning if he looks at the 10-year yield. And if that's their metric, well, it's down, and it's down hard. And I think that a lot of people are wondering whether the stock market is still the barometer. I will just note, NVIDIA down incredibly hard. You take a look at some of the pockets of pain, the specific pockets of pain. And this ultimately, and this is what we were talking with Stuart Kaiser earlier, there is a real question of how long you can expect this broadening out to continue if you do believe that growth is slowing.
So let's talk about objectives. Yes, rates are lower. Yields are down every single week of the Trump administration. The Treasury Secretary came on the program and talked about it. Yes, crude is lower. That's something they want as well. Crude is lower too. Is all of this by design, though? Are you telling me that they want consumer confidence to gap lower? They want weak retail sales? They want a soft ISM? They want new orders in manufacturing to be down and employment to contract? Because that's what's led to lower yields over the past few weeks.
If you take a step back, there are a lot of questions about what the ultimate goal is. If you have a reduction in consumer confidence, you also, and frankly, end markets, you end up with a reduction in tax receipts, which reduces revenues, which makes it more difficult to achieve the closure of the budget gap. On a broader level, there are questions about what the ultimate goal is with reordering the global trade system in the most dramatic way that we've seen since pre-World War II. I mean, that's the reason why people are saying this is a historic moment. It is historic for markets. It is historic for trade relationships.
Or is it potentially to force the Fed's hand to have them cut? This morning, traders adding to bets on interest rate cuts from the Federal Reserve. Now the traders are saying we can maybe get 3 this year. That's a shift from December.
I thought March 19th would be a snooze. I was very wrong. The next Federal Reserve meeting 2 weeks tomorrow is going to be very entertaining. Coming up this hour, we'll catch up with Omar Aguilar of Schwab Asset Management as tariffs grip global markets, John Murphy of Bank of America on how the levies will impact autos, and Michael Gapen of Morgan Stanley on downside risk to the labour market. We begin this hour with stocks coming off their worst session so far this year. Omar Aguilar of Schwab Asset Management writing, tariffs have the potential to raise inflation in the short run and slow growth in the long run. The impact would affect lower income households more as goods imported from Mexico and Canada, food, energy and auto parts are not discretionary items. Omar joins us now for more. Omar, welcome to the programme, sir. The facts have changed. We've got new tariffs. Has your view changed?
No, well, uncertainty is the name of the game, and certainly the discussion about the slowing growth is actually more real than it was even just a couple of weeks ago. When you look at the U.S. economy, I would probably say the good news is that we started the year on a very strong U.S. market and U.S. economy. And I think that seems to be, the support that we have by dealing with this level of uncertainty on these unprecedented changes in the global trade. I think a big part of the shift is also the barometer is on the 10-year yield. When we went from, discussing about term premium and the inflation expectations to now, the 10-year yield really pricing a lot of the potential is low growth going forward.
Let's talk about some of that lower growth. The ISM came out yesterday. The headline was just about okay, and only just. Prices paid started to pick up. New orders started to drop. Employment as well. Omar, do you believe we could see that reflected in ISM services tomorrow, in the payrolls report on Friday? How long before it really starts to hit the hard data?
Yeah, I think, the employment report is going to probably take another cycle. I think a lot of what we're seeing now is not going to necessarily reflect what has occurred in the last couple of weeks. I also think that will be a critical data point, going into this report and the next report, or the potential for the next report, for the Federal Reserve meeting coming up. Because if anything, the Fed is going to be paying a lot of attention to the labor market dynamics to decide what they're going to do next. I think the chances of a Fed cut, in March was actually very low. In fact, our point of view was there was going to be any changes. We still believe that the chances of a cut is still early. But that being said, the potential changes, of more cuts down the road are actually more, have higher likelihood as opposed to what was before. I do think that the manufacturing numbers will continue to deteriorate. And I think a lot of what we've seen already, even what we saw on the Atlanta GDP Fed numbers, estimates is actually everything is going lower.
At what point do Fed rate cuts make you more optimistic about risk assets, Omar?
Well, I think there is a big difference in here, Lisa, which is, when you see the Fed cutting rates as a mechanism where they see inflation going on the right direction, going down, and they see economic growth in the right place, that tends to be very supportive for risky assets. What we're talking about here is that the Fed will now change their view, which is they will reduce rates not because of inflation, going down, but really because they see economic deterioration, which is not necessarily the best case scenario for risky assets. Risky assets tend to do well when the Fed does that more as a result of seeing the economy going in an expansionary way, as opposed to trying to come and provide more liquidity and stimulus to an economy that is deteriorating.
We have seen this huge shift, Omar, in Fed rate cut expectations, as well as just more broadly in what the policy is actually going to be from the White House. How much have you shifted what you're doing, your allocations, specifically within stocks?
Yes, we have gone, with what we call more risk off and reduction of risk strategy. We believe that for the next, especially in the short and medium term, there is still going to be a significant level of volatility in risky assets as well as on bond yields that is not necessarily worth the risk to try to take a big, positions in one way or another. It is very hard when you actually look at the range of what we're seeing in the 10-year yield that has gone from being almost at 5 to being now almost at 4 within, just a few weeks. That level of bond yield volatility is something that we would like our our clients to just stay, out of it and stay close to their benchmarks, stay close to their long-term objectives. So our strategy right now has shifted more to be more conservative and try to use volatility as a mechanism to rebalance their portfolio and look for ways to just stay close to what they have. Emphasize quality is a big part of it. Emphasize dividends, which is something we didn't do last year, but it's starting to just emphasize those areas that tend to be more defensive in nature, as opposed to actually try to take, opportunities that are more speculative.
Omar, if market participants were complacent and thought potentially these tariffs weren't going to come into play overnight, do they need to start pricing in now every single tariff threat we hear out of the Oval Office?
I don't necessarily think that every single one, will be taken in the same area. I think the ones that we're seeing now and the effect is still not completely priced into the market. And specifically, the amount of levies that has been put or will be put in place, on Mexico, China, and Canada, we're talking about a $1.4 trillion, potential impact that, has an impact on GDP. But the area that has not been fully priced in is on earnings estimates that in our point of view, they're still pretty high. So I think, to answer your question, a big part of what I think the concern is that a lot of the earnings estimates that we saw going into the last earnings season, they still did not put into consideration the potential impact of what that may do for tariffs going forward. So we do think that there's still a lot to be priced in. It's going to take a little while. Now, that being said, it's probably going to be faster than what it was back in 2018. I think the mechanism where these tariffs may have an effect on GDP or in the economy as well as earnings will probably come in faster into the market than it was, back in 2018.
Omar, appreciate your time, sir. Omar Aguilar of Schwab Asset Management, thank you on the market and the latest tariffs. It's such an amazing moment for so many reasons. Here's one. Nobody believes it. Hardly anyone believes that this is actually happening. 25% tariffs on Canada and Mexico. We talked about a concept that's typically associated with foreign policy, which is mutually assured destruction when it comes to 25% tariffs on your biggest trade partners. That's what we've got. It's in effect overnight. And yet we're sitting here, and we said this a few times on this programme, the people who thought this day wouldn't come don't believe this day lasts very long. So what are they waiting for? When does the reality check actually come? Got to wait for the data, got to wait for the pass-through, got to wait for the consequences. Because right now, sitting here this morning, this isn't a big fallout in the equity market, down 0.7% on the S&P, within 5-6 percentage points of all-time highs on the benchmark. Yes, we've seen a big move in the bond market, but I don't think this is the reality check, the wake-up call just yet.
There has to be some sort of either lack of response from the White House as this drags on for a longer period of time, or there has to be real shifting in the supply chains by some of these U.S. manufacturers. I just keep going back to this idea that if you want to rejigger supply chains in a dramatic way, do you do it slowly in that drip, drip, drip that Scott Bessent was talking about, or do you do it all at once? I don't know the answer. I actually am curious to hear what CEOs have to say.
Well, Julian and Emanuel made a really good point, which is you have to really bring up the trade negotiations so early on because they're looking ahead to the midterm elections in 2026. So you have to do the bad things early on, get it out of the way, and then make sure you deliver on some of those good policies that could potentially help the markets or individuals, small businesses, deregulation, of course, the tax cuts.
It was always going to be about the sequencing, and you're going to have to wait a while for the taxes. You're getting the tariffs up front. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. We start with a rundown on President Trump's tariffs. He's imposed 25% tariffs on most Canadian and Mexican imports and has raised the charge on China to 20%. All this affecting roughly $1.5 trillion in annual imports. In response, Canada is set to impose phased levies on $107 billion worth of U.S. goods, and China is set to impose tariffs of up to 15% on American agricultural shipments. Meanwhile, Goldman Sachs CEO David Solomon says there is a very small chance of the U.S. economy entering a recession amid global trade policy uncertainty, as we're seeing today. Despite the optimism, Solomon also warning investors should carefully monitor how the credit cycle is impacting lenders and changing behavior. And we turn to Citi, almost transferred about $6 billion to a customer's account in a copy and paste error. Sources tell Bloomberg the near miss happened when a staff member copied and pasted the recipient's account number into a field meant for the dollar amount. It happened last year in April, the same month that another part of the bank accidentally credited $81 trillion to a different client. That's your Bloomberg Brief. John?
Yahara, thank you. Citi's not having a good run of stories over the past week, that's for sure. Up next on the programme, the Morning Calls Plus, John Murphy of Bank of America on how automakers are gearing up for tariffs. That conversation is up next. Equity futures near session lows. We're down by 0.75% on the S&P. This is Bloomberg. Close to session lows in the equity market. We're negative by 0.7% on the S&P 500. In the bond market a bit, once again, a rally at the front end and at the back end. We're down 4 basis points on 2s, down a single basis point on 10s, 414.36. Let's get you some morning calls. First up, Deutsche Bank downgrading JetBlue to hold, saying it's exposed to an economic soft patch that will weigh on travel demand. That stock is down by 1.7%. Your second call from Morgan Stanley reiterating its overweight view on Target after earnings, saying the company's guidance looks better than expected. That stock falling now by 2.5% in early trading. And finally, Bank of America cutting its price target on Tesla to $380, citing slower growth and rising risks. That stock is down in early trading by more than 4%. Let's stick with the autos. The sector bracing for the impact of President Trump's tariffs on Canada and Mexico. John Murphy of Bank of America writing, for 25% tariffs on every good transiting through the border, the auto industry would be burdened by an incremental $50 billion plus in costs. John joins us now for more. John, good morning.
Good morning.
We'll get to whether people believe it or not and why they don't believe it in just a moment. It's day one. What does Mary Barra at GM do? Jim Farley at Ford? What do they do today?
Well, I think everybody's a little bit in a state of shock to start off, but I think they've been game planning this for a while. And when you think about this, it is essentially similar to a supply shock. And we've gone through a supply shock recently with COVID. So you kind of think about that playbook. And when you look at what they're going to do, is they're going to focus on the vehicles where they make the most money, like they did in the past, and not produce the lower end vehicles to start. Then there's going to be a sort of a longer period of trying to understand whether this is really going to stick and how to rework supply chains if it actually does stick.
Do you think prices go up immediately? How do they play the price story?
I think you're immediately going to see a shock to the system. Our estimate with that $50 billion cost increase is that each vehicle in the United States, on average, would go up about $3,300. Obviously, there'll be varying degrees on vehicles that are actually crossing the border, which means that used vehicle pricing is going to go up by almost that amount as well. So I think we're going to see prices rise pretty quickly.
There's a belief that this isn't going to happen because it would really hurt these auto manufacturers so much as to be sort of detrimental to the popularity of the president. How long do you think it would take before we actually see the ramifications of that?
So I think what we're looking at is about mid-50-day supply of vehicles on dealer lots. So we probably have 20, 30 days of before we get into real issues of vehicles not being delivered to consumers or demand being fulfilled. Beyond that, you probably have a couple of weeks of finished goods inventory that's in the channel that can be worked through. So I think you're probably looking within the space of a month, there's real disruption in vehicles getting to the consumers that want them. I think the other thing that's really important is we're looking about at the front end of the value chain, 4% of GDP. You have over 3 million jobs that are affected by this. And I think there's a lot of folks that you hear in a political sphere that talk about, hey, listen, we're just going to have to take the pain in the short run. But those 3.1 million people have to, pay for their kids, food and pay for their mortgages and their rent. And I think really quickly you start hearing sort of this echo chamber, hopefully quickly from these folks saying, listen, we got to put food on the table. We got to pay our rent. We got to pay our mortgage. So hopefully there's some pushback pretty quickly in both red and blue states in the country.
I'm sure the UAW is lining up on the list of individuals who want to speak to the chief of staff. The issue with that argument, though, is that the administration is coming out. And what they're saying is, Scott Bessent this morning, Honda moving to Indiana is a great start. They think that this is necessary pain to actually get more jobs in the United States in the future. How long can that last?
Well, I think you can see a rebalancing and a reshoring of some production, particularly at the assembly level, into the U.S. and into North America. I think the real question is we're talking about this is really what is the end game? Is the end game to stop immigration and illegal drugs, or is it actually to bring jobs back to the U.S., or is it for political theater to garner greater political support for some other efforts that are going on. So it's very difficult to understand exactly where they're going with this. If they could explicitly say, if we bring more jobs back to the U.S. and we bring more manufacturing back to the U.S., that is our end game, I think the companies would know how to proceed and head in that direction. And they think they slowly are, and we're seeing reshoring of production to the U.S. And North America. But once again, shutting off Canada and Mexico is a very difficult thing to do because it is a contiguous supply chain that has been set up for decades to be very efficient. I mean, there's a lot of parts in Mexico that you can't get Americans to make, or could you pay Americans, cost effectively to make, that would actually be in higher cost than 25% to bring them back to the U.S. So it would be deleterious to the whole value chain.
There's also a renegotiation of USMCA at the start of next year. But if you have tariffs like this that stay in place, what is the point of USMCA?
I think you're bringing the negotiations forward to present day. I think that's what's going on, and they're trying to get it done as fast as possible.
One thing that you talk about is that if these go on, essentially it could be the equivalent of all profits for some of the auto manufacturers in the United States. Which auto manufacturers do you think are most exposed, or is this basically parsing the details on a Titanic that's sinking? I mean, is it something that you can really distinguish one from another?
It's a very good question. We've got to run through this. I mean, Ford is 15 to 20% of their production is in Canada and Mexico. GM is closer to 25 to 30%. You could say Nissan and Mazda would be the most impacted because they have heavy exposure, or most of their production is in Mexico for the North American market. But I think when you look at this, and once again, you look at supply shocks in the past, it is essentially an environment where distress is created, and in distress, there's convergence, meaning everybody is going to get hit by this pretty hard. And you're right, there will be greater pain potentially, potentially at Nissan and Mazda. But ironically, when you think about this, Jim Farley actually had a great statement in the last go-round when we were talking about this last time, just a few months ago, is that vehicles coming from Japan, Korea, and Europe are being tariffed at somewhere between 2.5% and maybe 10%, even on a reciprocal basis if other tariffs get put in place. Yet vehicles coming from Canada and Mexico are getting tariffed at a 25% rate. It advantages the folks that are importing from Europe, Japan, and Korea in a very odd way, and shows that this is not a holistic discussion and framework for tariffs, for the entire world and the U.S. all at once. There's some oddities going on as you're placing 25% tariffs on Canada and Mexico and only 2.5% to maybe 10% on other imports. It's a very odd structure.
They're next, John. That's a month away. We'll talk about that in a few weeks' time.
We got a long way to go.
Changes. You mentioned maybe echoes of the supply shock of the pandemic. I was looking at the likes of GM for 2020, stock up. 2021, stock up big time. What's the difference this time around?
Yeah, I think the difference this time around is cost for them is going to go up very significantly from their suppliers. So you're going to focus on the higher end products where you're making 20 to 30%, incremental margins, as opposed to stuff where you're barely break even or making small margins. But with that, you're going to see much higher costs that are passed on from the suppliers to the automakers. So I think the benefit to their profits will be far less than what we saw then.
You said something interesting earlier in the conversation that's still rattling my brain. These tariffs might not be high enough because for some auto parts makers, they'd be better off taking the 25% tariff and staying in Mexico. Is that right?
Well, I think that you cannot make certain parts viably or profitably, I should say.
Even more expensive to make them
here. It would be even more expensive to make them in the U.S. So the reality is vehicles wouldn't be made, or certain parts wouldn't be made, which means that certain vehicles wouldn't be made, and we'd be looking at a smaller market, which would put that 4% of GDP at risk and those 3 million plus jobs at risk, which was really kind of a tough thing to stomach.
This stuff is super complicated. John, thanks for making it clearer for us. Appreciate your time. Thank you.
Thank you.
John Murphy there of Bank of America on the automakers in the United States. So what a tricky moment for those companies.
At a time when they have to think about their supply chain and the possibility it might not be cheaper in any capacity. It just means that costs are going to be more expensive.
Still, there's so many people out there that just don't believe this lasts very long. We have an address from the President of the United States to a joint session of Congress later on this evening. Look out for that. Up next on the programme, Michael Gapen of Morgan Stanley, Jason Draho of UBS. From New York, this is Bloomberg. Taking another leg lower, 60 minutes away from the opening bell. We're down by 0.8% on the S&P 500, down by close to 1% on the Nasdaq 100. On the Russell, down by 2.8% yesterday, down by 1.26% this morning. With 60 minutes until the cash open with your morning movers, here's Manus Cranny. Hey, Manus.
Jonathan, let me just give you a little bit of a counter to that downside. We've got Walgreens Boots. It looks like we have a potential deal between Sycamore Partners taking the company private. We understand $11.30 at $11.40 if it goes through. So this is a $10 billion take private deal. What's the consequences? Possibly a breakup. Deutsche Bank say it's going to be incredibly complicated and unlikely to be consummated, hence the price differential between the price tag that we're hearing and on the board target. Get ready. The price rises are coming. Weak February sales. Price increases in the next couple of days. This is about setting a cautious tone. You've just had the autos conversation there. The reality of cross-border moves. Let's look at Tesla. 15% of the parts for the Model Y sold here in the United States of America come from Mexico. You have just had some staggering facts given to you on the auto sector. 4% of GDP, and you're looking at millions of jobs in this auto sector. And I also should just say, the Chinese sales dropped by 49% in February. Sting. Jonathan.
Manus Cranny, thank you, sir. I want to pick up on Target. Then the interesting thing here about Target, if they want to pass on higher costs to the consumer, Lisa, are those costs, those prices going to be bought by the consumer, or does the consumer push back?
What I think is interesting is that they're talking about potentially raising prices in the coming days. This is immediately passing it through. It is an immediate test of just what that appetite is.
Economic data is going to be key in the coming days. Yesterday, ISM manufacturing was weaker than expected beneath the headline. You saw that in prices paid up, new orders down, employment contracting. Will the data later this week confirm that? ISM services tomorrow. ADP as well. Jobless claims Thursday morning. All things we'll be looking for. Friday, payrolls. And then we start to talk about this one a little bit more. 2 weeks tomorrow, March 19th, a Federal Reserve meeting. And in that meeting, they have to put out some forecasts. Mike McKee joins us now for more. Mike McKee, March 19th just got a little bit more interesting, didn't it?
It certainly did. I'm not sure they're going to be able to give us much on March 19th because, as you've been pointing out all morning, these are just the first in a series of tariffs the president has threatened. So nobody knows exactly what the impact is going to be on the U.S. economy. What we're looking at is basically the playbook from 2018 when Fed staff wrote about the Trump tariffs at that point. And they said they were going to have a negative effect on the economy. The higher cost of imported consumption goods depresses household spending while business spending declines, both as a result of the higher cost of imported capital goods and as lower expected profits cause corporate borrowing spreads to rise. We are certainly seeing a reaction in equity markets right now. So the Fed staff at that time said there were two possible ways for the Fed to react. One, they could raise interest rates because inflation is likely to rise, given the fact that prices are going to go up, as we've been hearing all morning. Or they could look through the price rise, expecting it to be a one-time thing. The prices spike, but then they stop rising. But the concern was maybe they don't. In particular, the Fed staff said at the time, inflation and inflation expectations might run persistently higher if the tariff hike leads workers to raise their wage demands or firms to raise their markups. And they said that that might be intensified in a tight labor market, which we have right now. So at this point, it does look bad. It does look like it's going to have an impact on inflation. But what the Fed does about that is still a very open question. We'll get the first answer this afternoon. I'm going to sit down with John Williams, the president of the New York Fed, and he is, of course, the vice chairman of the Open Market Committee. And the vice chair usually doesn't dissent, so where he is probably where Jay Powell is. The question is, are they somewhere yet?
2:20 Eastern Time. Do not miss that conversation. Mike, looking forward to it. Mike, thank you. Michael Gapen of Morgan Stanley joins us now for more. Michael Gapen, what just changed for the Federal Reserve on March 19th?
Well, a lot. As Mike McKee, I think, pointed out correctly, that it really makes for a tricky situation. And their scenarios would say eventually we're probably going to have to, cut rates to support activity. But in the near term, it pushes inflation higher. We've just had inflation well above the 2% target for several years. So, they have to trade these two signals off. They have to be able to, they want to look through that inflation, but they won't be able to in real time. Because if these tariffs stay in, you could see headline PCE inflation go up by, maybe minimally 0.3, maybe up to like 0.6. So you'd have a major move higher in inflation just after years of being above target. They can't just knee-jerk look through that. They'll have to wait. They'll have to pause. We think ultimately they would ease, but there's a timing element here. Tariffs push up inflation now. They weaken activity later.
It's the activity piece of it, Michael, that I think is more interesting from our perspective. Obviously, this could lead to higher prices. That was always going to be the risk. It was whether consumers could absorb those higher prices. Right. We're already hearing from a number of retailers this morning. Target was in the media a little bit earlier. The CEO was saying we'll pass on these higher costs almost immediately in the next couple of days. Best Buy, we're hearing from the CEO that tariffs are highly likely to lead them to raise prices and might reduce sales by 100 basis points. And that's the piece of it that's interesting to me. Mike, if they put up prices, are those prices bought or not? Is this consumer in a position where it can absorb them, or do they push back?
Well, I think they absorb them, but only by buying less, right? This is the whole argument, and tariffs raise the cost of trade, so in the end you get less of it. So it's not that the consumer pushes back. Firms can't raise prices. Excuse me. Prices go up, the consumer buys less. That's what weighs on growth. If sustained, these types of tariffs could shave, we think minimally 0.7 off of growth for the year, maybe even a full percentage point. So if firms pass it along, the real cost of the consumer goes up. It's a tax on consumption, so you're going to get less. So the growth effect will be substantial, again, if they're sustained. And it'll phase into the economy over time. Maybe not immediately, but you'll see it within 3 to 4 months, I think, in the activity data pretty clearly.
There are a lot of ifs in there, Michael, and I'm wondering if we have a sense of where we are now concretely in a way that doesn't necessarily hinge on what could happen. In other words, are we seeing a true softening in the overall economy and consumer willingness to spend, or is this just a seasonal soft patch?
Well, at least, up through the data that we have in hand, we would argue, and I'd argue, that what we're seeing in the January data is just payback from a very strong fourth quarter. Consumption was running 4.2% or so. Durables consumption up 12% on an annualized basis. That's, kind of way above where spending, quote, should be. So just a snapback buying of autos after the storms in the fall. So some give backs expected. So right now we would say the data in hand tell us it's payback, not a turning point. But it's hard to look forward and say, oh, okay, that's fine. Everything's okay. These types of tariffs, the restrictions in immigration, you have a fiscal blueprint coming out of the House that calls for pretty significant cuts in federal spending, which are transfer payments to households, right? So there's a lot of things that could stack up here and say what looks like just payback in January turns into something softer over time. We believe that. So that's kind of the crux of the problem, right? The January data is backward looking at this point. We've got a bunch of things now stacking up saying whether it's the labor market or consumer spending or inflation, the next 3 to 4 to 5 months are likely to contain, a much less robust set of data for the economy.
Markets can move very quickly, and they are moving very quickly in terms of sentiment. But people often describe the economy in the U.S. as something of a barge trying to shift gears or slow down, and that it will take a long time to actually meaningfully hit the underlying dynamism of the United States. Do you think that's true, that even if there is uncertainty and these tariffs stay on for a while, that if they're removed by later this year, you could see a recovery of any kind of loss that we could have otherwise seen?
I mean, I think that's generally true, right? A simple rule of thumb is tariffs will hit inflation in 2 to 3 months and put activity in 2 to 3 quarters. But I would say it hits trade and manufacturing relatively quickly. It's just those two things are a smaller share of the economy. So to see it more broad-based, you need those spillover effects. That's what takes time. I think you can make an argument, obviously, that the more forcefully you move on tariffs, the more widespread they are, maybe you get those effects front-loaded. Moving supply chains now is probably a lot harder and a lot more costly. Some of the low-hanging fruit on that has already been picked. So yes, I would say that's right on first blush, that it's going to take time, but maybe it's different this time, right? So the models are helpful. We'll see how it plays out in real time.
Michael, Appreciate it, sir. Michael Gapen of Morgan Stanley. We're seeing this play out in real time right now with the Mexican president. We were waiting for Claudia Sheinbaum's response to this. 25% tariffs on Canada and Mexico. We heard from Canada. A news conference just started with the Mexican president just moments ago. Mexican president saying there's no justification for US tariffs on Mexico. Also saying that her government delivered on issues around fentanyl and security of the southern border. The pushback just beginning.
Pushback just beginning. You know, she has not decided what they're going to do in terms of the retaliation. We do know that they have a few plans and options, but she's upset right now because there has been a flurry of diplomacy between Mexican officials, U.S. officials on what they could do. They extradited some 21 members with links to the cartels to the United States. They put more money towards the border. They said they're cracking down on fentanyl. But guess what? Trump last night, he said it wasn't enough. The negotiations are over.
That news conference is ongoing. Any more headlines, we'll share it with you. Let's continue the conversation around the table. Jason Draho of UBS joins us now for more. Jason, good morning to you, sir.
Good morning.
A change in the tariffs. Is there a change in your outlook?
Not yet. I think that the issue that we're all dealing with is trying to figure out, how long will they be on? How many more tariffs there will be? It's been, kind of a very fast evolving situation. So I try to focus on what we understand, which is an economy that's in pretty good shape. Ultimately, we think the Fed's going to cut. We ultimately think the tariffs will probably come back, but be repealed. But that's an open question right now.
Help me understand how long they need to stay on to actually do some real damage, because it's already showing up in the survey data. How long do they need to stay on?
Well, I think if they're a week, that's not going to change the outlook. If they're a year, I think that starts to change the outlook. So the question is where in between?
A year, we're down 15, 20, 25% on the equity market. It's too late. So when do you start to really care about this?
So I think I'd look at it in the context of the other policy that's going on. So on March 14th, we could have a government shutdown. That seems reasonably likely. There could be further DOGE cuts, uncertainty there. So I think for the next month or two, there's definitely going to be an air pocket for the economy. The question is how much, and does the administration then sort of flinch? Do they say at that point in time, all right, Canada and Mexico have come to something that we can sort of maybe renegotiate now or reopen the U.S.-Mexico-Canada Free Trade Agreement? As we do that, we'll suspend the tariffs. So I think the next 4 weeks will be kind of a telltale of will they go on longer, or could that be a pain point enough that they want to pivot at that time?
Are you starting to question how much momentum the U.S. economy has going into a potential air pocket, given that we have seen weakening data before some of these tariffs were even put on?
So look at the consumption data we got last week. The retail sales was a little bit weak. The consumption data, the personal consumption last week was below expectations. I think real consumption was down 0.5% month over month. Expectations were basically flat. But if you look at year-over-year numbers, it's still elevated. It's still around 2.5%. What we know in the second half last year, real personal consumption annualized to 4.5%. The Americans were spending in the second half last year, the fourth quarter. Some pullback in January when it was cold, seasonal factors. I think we gave kind of a one-off. Sort of like last year when inflation was hot, we gave it a month or two pass. We also know that real income last week, it was less attention, but the real income, or the income grew 0.9% month over month. So if real incomes are growing at 2% this year, that's going to support consumption, that's going to support the labor market. So as long as incomes are growing, I think we can, handle this, okay. But clearly, the longer this persists, the greater the downside risks.
When we came into this year, so many asset allocators were talking about policy uncertainty and how they had to go back to the fundamentals because there was so much policy uncertainty. Is there still policy uncertainty, or do we have more policy certainty? Can you take what we've gotten as more of a template for what's to come and make some more base cases?
So I think, the view for most people, for most investors post-election is that we get a bit of a replay of Trump 1.0. We get these reflationary policies, you get tax cuts, deregulation, markets will go higher. What we're finding out is, one, the sequencing is different. We're getting tariffs, we're getting government cuts first, maybe tax cuts later on. But it's also, something I'm kind of questioning is when the administration says we're actually willing to tolerate pain. I think Besson sort of came out this morning to said that. I kind of thought, there's a Trump put, but the Trump put is for treasuries more so than equity markets this time. They need, yields to go lower. They want inflation to go lower. And we may be underestimating that the markets might say this is a policy error that they're undertaking right now, but actually might be for them, this is part of longer-term strategic strategy. They're willing to take the pain now. With 12 months from now, things will be better, and then you kind of go into the midterms. I think the market's underestimating that possibility, that maybe the whole framework we're thinking about this administration has been wrong.
When you talk to the Treasury Secretary, and he joined us around this table, he was excited with where yields were and going lower. And to boot, today you have WTI down more than 1%. They want to see lower energy prices. So what's the pain threshold you think they're willing to accept, though, when it comes to equities?
Well, equities are going to probably correlate with the economic data. So if you see, job gains on Friday that are like below 100,000 from March, again, like 50,000 or something along those lines, unemployment rate ticks up. That starts to become pain. If you see inflation going higher, particularly for goods that people are buying on a regular basis, food, things of that sort, then it starts to become a political problem. I think that becomes more of an issue than it does the stock market. When we think about the Trump put, I also go back to 2018. In December of 2018, it wasn't really fun times in the market, but the S&P fell 14% from December 1st to Christmas Eve, and 20% in total. And there was a lot going on. Some of it was included a 32-day government shutdown. So we know that there was sort of tolerance for more pain than the market assumes, where like the put could be like 5% of the money. That's clearly not the case.
Yeah, 5% pullback is not going to get it done, based on what you've just said. Jason, wonderful to get your thoughts. What a tricky moment for the global economy and for all of us to work through at the moment. Jason Draho there of UBS. So let's do two things. Let's talk about what we've got, one, and two, how these countries are responding to it. So this is what we've got. 25% tariffs on Mexico and Canada on most of their imports, an additional 10%, 20% now, that levy on China. The response we had from Canada and China is as follows. Canada imposing phased levies on $107 billion worth of US goods. China deciding to impose tariffs of up to 15% on American agricultural shipments. And just moments ago, we learned this from Mexico. The Mexican president holding a news conference and saying, we will announce countermeasures on Sunday. So you'll get those countermeasures from Mexico on Sunday. But you've already had quite stern pushback from the Mexican leader. There's no justification for US tariffs on Mexico. And with regard to some of the issues around fentanyl and on security, her government, she says, has delivered on fentanyl and on security.
Because they did do a lot of work that the administration was asking for. They're meeting with individuals like the Commerce Secretary Howard Lutnick. They're also meeting with Trump's border czar to try to do more to acquiesce what the administration is concerned about. What I find most interesting about all these statements is the date, Sunday. She's basically giving the Oval Office, Trump and his team, 5 days to potentially come to an agreement before she comes out with her plan and retaliatory measures. We
talked about muted price action in foreign exchange. As that pushback comes from Mexico, you get a weaker Mexican peso. Dollar Mex, that move now about 1.4%. One to watch throughout today. Let's give an update on stories elsewhere this morning. Here's your Bloomberg brief with Yahara Hackers. Hey, Yahara.
Hi, John. Arab leaders are set to gather in Cairo to endorse a Gaza reconstruction plan to counter President Trump's proposals. The plan faces major hurdles, including disagreements over Palestinian governance of Gaza and the future of Hamas. Overshadowing the summit is the risk that fighting resumes between Israel and Hamas after a 6-week ceasefire expired on Sunday. Meanwhile, traders are adding to bets on interest rate cuts from the Federal Reserve as worries grow over how U.S. tariffs will weigh on growth. Money markets have moved to fully priced 3/4-point reductions this year for the first time since the middle of December. And some breaking news from Starbucks. They've named Nordstrom's Kathy Smith as its CFO, according to a filing. Smith has served as executive vice president, CFO, and treasurer at Nordstrom since 2023. Meanwhile, from 2015 to 2020, she held the role of CFO at Target. Shares are up slightly. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. The opening bell is about 43 minutes away. Up next on the programme, we'll set you up for the day ahead and we'll count you down to President Trump's joint address to Congress. Your equity market negative by 0.6% on the S&P from New York. Good morning. Here's your market picture, about 38 minutes away from the opening bell. Equity futures negative here by 0.7%. Bid into the bond market, rally at the front end and the long end. We're down by 2 basis points on 10s, 4.13. This is week 8 of lower yields in the bond market, 8 consecutive weeks of it on a 10-year maturity. Your trading day looks like this, 9 p.m. Eastern time. Look out for this. President Donald Trump delivering his joint address to Congress tomorrow. Some data, ADP private payrolls, ISM services index Thursday. Another round of jobless claims Friday. The payrolls report and comments from Fed Chair Jay Powell. What a week still to come. As we look ahead to that address this evening, here's Bloomberg's Tyler Kendall from the nation's capital for more. Tyler, what are we looking for later?
Well, John, according to the official White House guidance, they are allocating at least 2 hours for President Trump to be on Capitol Hill. And we could go through all of the big themes, but of course, the economy, no doubt, will be front and center, particularly against this tariff backdrop. And President Trump is going to try to convince the American public, but also lawmakers in that chamber, that his economic agenda is working. Because up to this point, right, most of his actions have been unilateral. But he's soon going to need Congress's buy-in in order to get some of his more ambitious fiscal agenda items over the finish line. Republicans have very slim majorities in Congress, and right now we're already starting to hear concerns, for example, about making his 2017 tax cut plan permanent, as well as concerns about what spending cuts could mean to social programs like Medicaid. So we'll see if he addresses any of those concerns there. And then also, we can't forget, we are exactly 10 days away from a potential government shutdown. John, the economy no doubt will be a top focus on both sides of the aisle. We'll also be closely watching the Democratic response. It's going to be a late night here in Washington, but first-term Democratic Senator Elisa Slotkin of Michigan is set to deliver that once President Trump finishes.
Tyler, I'm excited to be making my way down to Washington, D.C. after the show to join you at the Capitol for this. That's a lot of the economics we might hear about from President Trump. But what about on the foreign policy side, especially given the fact that they're now pausing weapons that were in transit to Ukraine?
Right, exactly, Annmarie. And I just spoke about what the Democratic response is going to be. Of course, we'll be watching to see what European allies' response is going to be after President Trump's speech tonight. You mentioned there, of course, this pause in shipment. It wasn't immediately clear exactly how many of these weapons have been paused when it comes to military aid. But what is clear is that anything that was in transit was indeed paused, including in our ally Poland, where those weapons are being stored before they head over to Ukraine. So big questions there, particularly as European allies and Ukraine try to forge a way forward here with this White House to get those negotiations back on track.
Hey, Tyler, appreciate it. Look out for the coverage from the team a little bit later on this evening. Tyler Kendall there in Washington, D.C. Deutsche Bank with this note: the window is open. They say the market has now entered the window where it needs to start pricing policy that is not aligned with the administration prioritising economic growth and the presence of an S&P 500 put. They go on to say, put simply, the longer time goes by with no reversal, the more US and global growth downside we have to price in. We're taking this day by day, week by week.
Which is the reason why I'm watching for the downgrades. Nobody wants to be first. We can feel that. Everyone is feeling like maybe you have a different parameter here for what this administration is going to look like. Right now, at what point can you take away the Trump put at a time where Scott Bessent this morning said, over the medium term, which is what we're focused on, it's a focus on Main Street. Wall Street's done great. Wall Street can continue to do fine. But we have a focus on small businesses and consumers.
Keep a cool head. That is how Claudia Sheinbaum just ended her address. She wants to project that they have this plan, and we're going to keep a cool demeanor when we're dealing with the President of the United States. But she says on Sunday, tariff and non-tariff measures, that's when they're going to go into place.
We've had a 5% pullback on the S&P 500. They're not blinking. Down in the White House on a 5% pullback on the S&P 500. We've had a much bigger pullback in the bond market. Yields are lower again, 6 basis points lower, Lisa, at the front end of the curve.
So what would it take for them to care? And at what point are yields lower not necessarily a positive signal at a time where they don't reflect disinflation? They reflect slow growth. And that is a huge distinction.
More data tomorrow and through the week. Coming up tomorrow, we'll catch up with Peter Cheer of Academy Securities, Bob Michael of JP Morgan Asset Management, Monica Guerra of Morgan Stanley, and Congressman French Hill of Arkansas. What a change for the global economy. Will it really change? Will these tariffs stay on? People are still asking those questions. Are we living in denial? 25% tariffs on Canada and Mexico, an additional 10% on China. Equities near session lows from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.